So, my dear students, I hope most of you have sat for the mock exam and planning for sitting to the final exam, corporate level exam in the upcoming couple of weeks. I think within less than 2 weeks, we are having almost 1 week to go. Your exams will be starting. So, what we have looked at in advanced management accounting or CL3, before I move on to the question, let me give an overview. uh, like this mock exam, we tried our best to prepare it and give it to you. Give a similar experience to the exam, but please don't get me wrong. I have no connection with the Institute of Chartered Accountants examiner, or I don't have any access to the exam panel or anything. So this is not an identical uh, like it's not going to be identically similar to what we are going to get at the exam. So please don't expect that. But what we have looked at is, I must thank Harun and the team, the CS Sri Lanka team, for supporting me. We have looked at areas based on the last examination where the examiner's comments also have been uh, shared, where students have not performed very great. So what we have done now best here is to set a set of questions in a similar format to the your final exam. Like you have the section 1 with the 10 MCQs, section 2 with 4 questions carrying 10 marks each, section 3 with 2 questions carrying 20 marks each. And we have tried our best to give a similar weightage of 5 sections in your syllabus. If I just remind you on your syllabus, right, as all of you should be having the study pack by now. If you look at the syllabus, basically they are dividing this into 5 different sections. So 5 different sections, they are giving different weightages. So we have tried our best to abide by that. For an example, if you take section D, where the project long-term decision making, the decision theory and risk management is there, 15% of the weightage. So we have tried our best to keep it around 15. It can be 16, 17 or 13, 14, slightly vary. That's the same case in the real exam. If you look at section 5, the working capital management, 10% of the weightage is given. So we have looked at keeping the same weightage in this paper as well. So this is a similar structure that you might get at the exam, but please don't expect same or similar questions at the exam. So this is just a mock exam. What I want to highlight at the beginning, for an example, here I have said some questions out of budgeting and standard costing as MCQs. In your real exam, you might not get any MCQ from budgeting and standard costing, but there may be a 10 mark or a 20 mark question. So please don't blame me or institute on any of that. This is just for you to give an understanding or give some previous experience prior to the exam to see where you stand and where you can focus on. And at the same time, it's all about time management. So with that, I will start off with the section 1. You can see 10 MCQs, 20 marks. Recommended time is 36 minutes by CS Sri Lanka. If you can finish before 36 minutes, that is ideal, but recommended maximum time is 36 minutes. Now, the first question that was given, I hope question is clearly visible to you. Which one of the following is not a characteristic of business process re-engineering, right? So this is just to test your theoretical knowledge on BPR or business process re-engineering. Often several jobs are combined. Checks and controls may be reduced and quality is built in. Small incremental process improvements, radical redesign of the business process. So if y'all are if y'all have studied business process re-engineering, that is ideal. But these things, of course, I'll give you a reference a little bit on the study pack content as well, right? So so except for one of these answers, so the rest of the stuff is actually based on the business process re-engineering. So if you have gone through these theories, that will really help you, right? So for an example, if you go back to the question, now it often several jobs are combined in a business process re-engineering. We are looking at recognizing, or we are looking at rethinking and a radical redesign of business process. This is what we are talking about. So here you can see, if you look at this is study pack page number 112 I'm referring to. Often several jobs are combined into one, right? So it's like, you know, often several jobs are combined. It's there. Workers often make decisions. The steps in the process are performed in a logical order, right? Check, okay. Those two are not there. Work is performed where it makes most sense. Checks and controls may be reduced and quality built in. Okay, E, that is also given. Checks and controls may be reduced and quality is built in. So this is straight away from your study pack. If you have studied the theory, you know that. One manager provides a single point of contact. The advantages of centralized and decentralized operations are combined. But I have put radical redesign of business process. That is the definition of BPR, right? So what is not relevant for this one is answer C. Small incremental process improvements. Where do you get the small incremental process improvements? That is in Kaizen costing. So my dear students, these areas, target costing, Kaizen costing, life cycle costing, total quality management, just-in-time, business process reengineering, supply chain and value chain. Those are modern management approaches. Be thorough with any of these. Yes, exactly, Hirun, right? Kaizen, that's Kaizen, right? Small incremental. So that is not relevant for business process reengineering directly. Not a characteristic of business process. So it's very simple if you have studied these theories. If you have still doubts, my recommendation, go through these modern management approaches theory. In life cycle costing or target costing, you may get certain calculations. Kaizen, very rarely you might get something, but rest of the areas what I mentioned are more theoretical. So if you know the theory, you can answer a question like this. So please let me know if you have any doubts or any questions. You may post it on the chat for the time being. I'm not too sure whether you can unmute yourself and talk, but you can post your questions uh, uh, in the chat. If it is relevant for what I am discussing right now, I'll immediately address. If not, I'll allocate a different time to address all your questions. So please be interactive, right? I'm happy that you all are interactive already. So please, if you have any doubts, just let me know. 1.2, which of the following statements correctly describe the company's value chain? So this is about the Porter's value chain, right? Primary activities include infrastructure, human resource management, technology development, and procurement. Primary activities directly contribute to the production and sale of products or services, such as inbound logistics, operations, and outbound logistics. Now, you need to remember that diagram. I'll come to that. After sales services do not belong to the primary activities, but to supportive activities. Okay. After sales services do not belong to the primary activities, but to supportive activities. If you remember the diagram, you can answer this. Both primary and support activities, it should be supportive, small printing error there. That's okay. Primary and supportive activities are relevant in determining an organization's competitive advantage. So which one is correct? Right. Now let me take you all through a little bit on the value chain. Yeah, the value chain analysis, Porter's value chain diagram. If any of you are not comfortable with that, okay, right? So yeah, right. So on value chain, basically, right, okay, we are there. Right, this is the diagram that you need to remember. Okay, now these things, inbound logistics, operations, outbound logistics, marketing and sales, and services. These are the primary activities relevant for production or providing the service. Basically, it's more into productions, but these are the primary services that we are looking at. But firms, infrastructure, human resource management, technology development, and procurement, these are supportive functions, right? So this is what you need to remember, right? So here also the same thing. Okay, so there are a few other minor aspects that you can look into, but basically you need to remember what are the primary activities, what are the secondary activities of the value chain analysis. So primary activities include infrastructure, human resource management, technology development, and procurement. No, this is wrong, right? This is wrong. This is secondary activities. Primary activities directly contribute to the production and sale of the products or services, such as inbound logistics, operations, and outbound logistics. Yes, this is correct. This is a part of what do you call primary activities. After sales services do not belong to the primary activities, but to supportive activities. Where do after sales services, right? So after sales services also, it's coming under the services, marketing and sales and services. So that is wrong. That is not a correct answer here. Okay, and yeah, let me come back to the paper. So this is after sales services is also part of this marketing and sales, and after that the services. Services means basically after sales services, right? So whatever the repairs and warranties, guarantees that you provide, free services that you provide, likewise. Both primary and support activities are relevant in determining organizations committed. Yes, not just primary activities, you need the support of secondary activities as well. So the correct answer is, which of the following statements correctly describes? Read very carefully. It's 2 and 4. Answer is B, right? So if you have any doubts, please let me know. Because if you know the theory, if you remember the diagram, please go through this before you go to the exam, right? Please remember that diagram. You can answer any question out of value chain, like basically read the rest as well, but just don't forget that diagram. What are the 5 primary activities and what are the 4 secondary activities there? Okay, number 3 actually requires some sort of a calculation. A standard labor cost of a unit is set at rupees 2,000, 4 hours at rupees 500 per hour at the beginning of the month. Due to inflation and other economic activities, the standard rate was revised to 600. So it was revised to 600 per hour during the month. During the month, the company has manufactured 1,000 units consuming 3,820 hours at a cost of 2.46 million. 2,460,000 is the cost. Calculate the labor cost planning variance, operating labor rate variance, and operating labor efficiency variance of the company during the month. Now, to answer to this, even if you are at the exam, you may get 1 or 2 questions or maximum 3 questions out of the MCQs, my dear students, where you'll have to do some calculation or you'll have to spend some time, use a rough paper and spend some time and answer. Not everything will be directly from the theory, right? Which is why I gave one question like this. So here, let me share my answer sheet at the end of this session. Arun and the team will take the responsibility to share this answer sheet also with you, so that y'all will have it. Y'all can go through any doubts that if you are unable to catch it up during this session. So let me quickly share my answer sheet as well. Hold on. Yeah, we can save a bit of time. At the same time, I'll explain with that answer how you arrive at that. Okay. I hope y'all can see my screen now. So wherever I'm moving, you can see. Let me double check. Can you all see the answer sheet? No, you still can see the question, I believe. Let me stop share and reshare. Yes, now I'm sharing the answer sheet. Okay. So you have all the answers here, right? So you all can cross-check yourself if you have already done the paper and if you have a copy of the paper. But here, let me explain a little bit, right? So this is the answer, right? Answer is highlighted in yellow color, but let me explain a little bit. In variances, my dear students, you get 2 types of variances. Planning variances and actual variance, operational variances. Planning variances and operational variances. Now, planning variances mean, in simple terms, it's like something that the top management has not seen, something that the top management has not seen during the planning stage or preparation of the budget. Problems with the budget. At the time of preparing the budget, either that was not visible or they have not seen it, they have not considered it. Okay, that's a planning variance. Operational variance, the responsibility comes to the employees or like not the top management. You know, in the hierarchy of management, you have the top management or the strategic management who are responsible for preparation of the vision, mission, and long-term goals, and even setting up the budget. Top or strategic management plus middle management will be responsible. Middle management or tactical level, right, or functional level. All these terms are used at different places in management, right? So top or strategic level management is there. Then you have the middle tactical functional level managers and operational managers or supervisory level, right? Lower level. And finally, you get the operatives. This is how the pyramid goes in organization structure, right? Now here, top level and maybe the middle level, if they are involved in the budget preparation, they have not seen it. That is coming under planning variance. So here what has happened, if you go back to the question says, standard labor cost was set at 2000. 4 hours was the standard number of hours. 500 rupees per hour was the standard cost per hour, right? Original standard cost per hour was 500. Original standard cost per hour was 500, right? Original standard cost per hour was 500. But it has been revised to 600, they say. In the third line, due to inflation and other economic factors, the standard rate was revised to 600. Now, inflation and other economic factors, right? They have not seen, or either they were not aware or they were not visible at that point. Due to whatever the reason, you can't put that blame to the operatives. You can't put that blame to your ordinary employees and the supervisory level, right? So that is coming under planning. So they have not seen that. How do you get the planning variance here? I have just given the answer here, but let me write down the this thing also, right? Standard rate minus actual rate, right? Standard rate minus actual rate into the number of hours. How many hours during the month company has manufactured 1000 units consuming 3,820 hours at a cost of 2,460,000, right? So let me just check. Yeah, so this is like, you know, manufactured 1000 units. Okay. Consuming 3,800. I'm sorry, this has to be, there's something, it has to be manufactured using 1000 units consuming 3,820 hours. That is the actual number of hours at a cost of 2,460,000. Okay. Now in this case, yeah. So they have looked at labor cost 500 per hour at the as the original standard rate and 600 per hour as the revised standard rate. Sorry, let me correct it here. Here, I think there's a small mistake from my end. I'll correct it here. These two are okay. Here, I will correct it. I'll like, you know, we should know the correct answer here, no? Right? So this is standard rate. The answer that I have given contains a slight error. Let me correct it. Don't worry, like you'll be getting marks for that one if there's an problem with from the examiner's end. It has to be the standard number of hours, right? Standard number of hours, total budgeted number of hours. Right? So it's not the 1,000 that you need to consider here. Yes, I think there's a question from yeah, you should be able to get the recording. Just check with the management, CS Sri Lanka. I don't know exactly, right? So this has to be the total number of hours, not the number. I have considered the number of units here. My mistake here. It has to be based on the total number of hours. That is 4,000. So let me correct it. Don't worry. Like if you had any difficulty at the exam, I'm sorry. It has to be 400,000 rupees adverse, the planning variance, right? I'll correct it in the answer that I'm giving. I'll correct it, right? So all of you will be getting marks for that part if you have gone wrong, because I think all places I have given 100,000 favorable or adverse. It has to be 400,000, right? It's based on the number of hours. I'm sorry, here I have considered the number of units. My mistake there. It has to be number of hours, right? But it's total budgeted hours, because you budget initially 500 hours at 4,000. Really, you should have budgeted 600 units at 4,000. It has to be 400,000 adverse, right? So please correct that. Labor rate, now here you get the operational variances. These are responsibilities lying with the operatives and the supervisory level management, right? Now here you go by the normal standard costing and variance analysis formula that you have studied, or some of you might have studied a different method than the formula. If you are comfortable with that, please go through, right? My recommendation to all of you is there's a pattern, right? Price variance, if you get, you have the material, you have the labor. I'm just revising a little bit relevant for standard costing and variance analysis also. I can just give the answer for this, but I'm just revising a little bit since you are close to the exam. Variable overheads, I'll take the fixed overhead separately. Yeah, these are the cost variances that you get, and sales variances you get. Those are the 5 main variances. Now, material, my dear students, material price variance. Okay, I'll just put the price or rate here. Material price variance, you get standard price minus actual price into actual quantity. Actual quantity purchased actually, right? But I'll just put actual quantity. Purchased and used are normally the same. If they are different, you take the purchase, right? Same pattern. Labor rate variance. Price becomes rate. Standard rate minus actual rate into actual hours. Variable overhead, assuming it is depending on the labor hours or machine hours. If it is something else, you can't. Labor hours or machine hours. Variable overhead expenditure rate variance. Same way. Standard overhead rate, like labor rate or machine hour rate, minus actual rate into actual hours. It can be labor hours or machine hours depending on the sum. You see the pattern? Standard price minus actual price, standard rate minus actual rate, standard rate minus actual rate, multiplied by actual quantity, actual hours, actual labor hours. They are actual hours can be the labor hours or machine hours. Same pattern, right? Fixed overhead, you get a different one. Budgeted fixed overheads minus actual fixed overheads. Whether you are applying marginal costing method or absorption costing method, this is correct. This is the thing. Sales, you want to increase the revenue. The other way around. Actual price minus standard price. Actual price minus standard price. Okay. Into actual quantity of sales. Okay. Actual quantity of sales. This is the pattern you need to remember. I know most of you know this, right? Most of you might remember this. Some of you might be using a different method. If you are comfortable with that different method, please continue, right? If you are okay with that, don't worry about this method. Please continue with that method. But if any of you are not comfortable with any of those, please note this down. This will be your mantra for the exam, right? Or any variance the examiner can test at standard costing variance analysis fall into this five. These five, that is the price or the rate variance, one type of variance. What is the other one? Usage variance or efficiency variance. Okay, usage variance or efficiency variance. Other type. Material usage variance, that also I'll quickly write down. That's based on the usage of the variances. So that is like always you multiply it by standard price. I'll first come to the usage part. Actual quantity, sorry, standard quantity for actual production. I'm always giving the formula, my dear students, in a way that if you get a plus answer, positive answer, it's a favorable variance. Minus answer or a negative answer, you get an adverse variance. That is why I'm giving like this. Price and rate variance also 5 I have given. Plus answer if you get, a positive answer if you get, it's a favorable variance. Minus answer or a negative answer if you are getting, it's an adverse variance. Okay. Standard quantity for actual production minus actual price into standard rate. Always you go by the standard rate outside. First one, always you have an actual outside the bracket. Here, always a standard outside the bracket. Standard quantity for actual production. That's a budgeted quantity for the actual production. Labor efficiency variance. Same way. You copy this down. Copy this down. Only thing what you have to do is change the word quantity to hours and change the rate. Sorry, this is actual hours. I'm sorry here, not actual price. It's actual rate, actual quantity used. Sorry, I'll correct it. Actual quantity, standard quantity minus actual quantity. Here, quantity becomes actual hours and standard rate becomes standard price. Here, standard price becomes standard rate. Even if you put standard rate, not a problem. Huh? Material loss, even if you put standard rate, not a problem. You just apply the price there. Variable overhead efficiency variance also same. Variable overhead efficiency variance also same. Same formula. Same formula. Standard number of hours for actual production minus actual hours into standard rate. Only thing that can vary is if variable overheads is depending on labor hours, it's the same labor hours. If variable overheads is depending on the machine hours, you have to apply the machine hours. That's all. Here, under marginal costing, right? Fixed overhead efficiency variance, there's nothing like that. But under absorption costing, you get, right? There are capacity variance and efficiency variance also. If you want, I can explain that, but I don't want to go into that extent. Fixed overhead, like volume variance, we say, under absorption costing. Sorry, not the efficiency variance. The word is volume variance. There's nothing called volume variance in marginal costing because fixed overheads do not vary according to the level of factory and a marginal cost. No volume variance for marginal costing. But if your company is using absorption costing, the traditional method, there will be, it's the opposite way. It's the opposite way. Actual hours minus budgeted hours. Into standard fixed overhead absorption rate per hour. Bit difficult to remember. Logic is bit tricky. Try to remember. Actual hours, only exception in cost variances. Look at this. Standard minus actual, standard minus actual, standard minus actual, budgeted minus actual, standard quantity minus actual quantity, standard hours minus actual hours, standard hours minus actual hours. Only here, my dear students, you get a difference. Actual hours minus budgeted hours into standard fixed overhead absorption. Standard fixed overhead absorption rate can be based on labor hours, can be based on machine hours, can be a per unit rate, right? Per unit rate, right? You can go with the units here. I'll first put the units. Yeah, it's the units per unit. Fixed overhead cost per unit. But in addition, sometimes you get capacity variance, and efficiency variance. Capacity variance and efficiency variance. Okay. Volume variance only you can get if you are given the fixed overhead absorption rate per unit. Fixed overhead absorption rate per unit, right? But here, efficiency variance, you get the same thing with hours. What I wrote earlier actually has to be efficiency variance. Sorry. Capacity variance, you get the same thing with hours. Actual hours minus budgeted hours minus into standard fixed overhead absorption rate per hour. I repeat again. Fixed overhead volume variance only if they are asking, you should be given the per unit fixed overhead absorption rate. 3 rupees per unit, 5 rupees per unit, 10 rupees per unit if it is given. How many actual units, how many budgeted units? You get the difference into standard fixed overhead absorption rate. Why? If your actual quantity is more than the budgeted quantity, you are like absorbing more. It's something similar to over-absorption, not exactly the over-absorption, but something like the over-absorption. To get the correct profit, over-absorbed cost you remove. Then the profit goes up. So if your actual quantity is more than the budgeted quantity, actual units of sale is more than the budgeted units of sale, you absorb more. Absorbing more is wrong. You eliminate that absorbed part, then your profit will go up. Therefore, this is like an over-absorption, volume variance. But if you apply it for hours, if you are given fixed overhead absorption rate, let's say like this is 50 rupees per unit. This is given as 50 rupees per unit. But here you are given as 5 rupees per hour. 5 rupees per hour. Right? Now then, you have to apply the capacity variance and efficiency variance. So unit becomes hours here. Actual hours more absorbed budgeted than the budgeted hours. Standard fixed overhead absorption rate. Your capacity variance is high. Efficiency variance you get like this. Labor efficiency and variable overhead efficiency, same ratio. Same way. Only the figures will be standard number of hours for actual production minus actual hours into, don't just put rate, it's the standard fixed overhead absorption rate per hour. Please remember this mantra. You remember one set of formulae, you can remember these two. If you remember the first two formulae, you can remember these two, just a change of words. Here you have to know a little bit, either by heart or either, practice that, know a little bit. It's a bit tricky. But efficiency variance, same as labor efficiency variance and variable overhead efficiency variance. Capacity variance and volume variance are similar. Volume variance, you have the units. Capacity variance, you have the hours. Sales variances, I told actual price minus standard price into actual hours. Sales volume variance, you get a volume variance here. Same as fixed overhead volume variance. Actual quantity of sale minus budgeted quantity of sale into not the standard price, my dear students. If you put price, you get the revenue variance. But we want the impact on the profit, impact on the contribution, right? It is standard contribution per unit if you are using marginal costing method. marginal costing approach, marginal costing approach. These are the tricky points that you need to remember. Sorry. Marginal costing approach. Marginal costing approach. I could have just given you the answer for this lesson, but I'm revising the entire thing so that you won't forget this at the exam, right? Any question out of variances, you should be able to answer, right? Here, this is standard. Sorry, cannot capital. It needs to be simple T. If it is absorption costing method, you get the standard profit per unit. You can calculate a profit per unit only if you are absorbing fixed overheads. Otherwise, it's the contribution per unit. That's the only difference. So please read the exam at the exam, whether it's a marginal costing question or an absorption costing question. Depending on that, you will have to change the variances like this. So I'll share this entire sheet with Aruna and he will share it with y'all, right? So, or you, if I don't know whether you can get the recording or not, but I'll share this with Aruna. He'll make sure that this will be shared with y'all so that you can go through this before the exam. Okay, right. This part is relevant for something else. I'll just cut and paste it a little bit below. Yeah. Okay. I'll leave it as it is. I'll leave it as it is, but I'll get these things copied and pasted somewhere above. Right. Okay, relevant for this one. Coming back to this question, the answer. Operational variances, I have asked the labor rate variance. Now you know the actual hours into standard rate minus actual rate. Now here what I have done is standard rate is given 600. Now the revised standard rate, you have to consider the revised standard rate here. Why? The blame for not considering the revision, we are putting it to the top management. So they are penalized. But rest, employees are getting penalized because they are working 3,820 into 600 should have been the budgeted cost relevant for this labor rate. But actually they have spent 2,460,000. If you go back to the question, right? Question is telling during the month the company has manufactured 1,000 units consuming 3,820 hours at a cost of 2,460,000. So you don't have to find out the actual rate, my dear students. Here what I am doing is, okay. Here what I am doing is, I just expand labor rate variance equals actual hours into standard rate minus actual hours into actual rate. That's all. Actual hours into actual rate, the actual cost is given 2,460,000. Actual hours 3,820. Standard rate 600. So you get 168,000 adverse. Labor efficiency variance, standard rate into standard hours for actual production minus actual hours. Standard hours for actual production, 4 hours per unit into 1,000 units. Actual hours, 3,820. So multiplied by 600, the standard rate, you get 108,000 favorable. Total operating variance, if somebody takes, that is 168,000 adverse plus 108,000 favorable, 60,000 adverse. But that I am not asking. So here my mistake, here I think erroneously I have put this one. I'll stop share and go back to the question, right? Question is, hold on. Right. Let me share the screen. Yeah. I hope y'all can see. Yeah, you can see. My mistake here, all have to be 400,000. You won't get penalized, right? Don't worry about it. Okay. So here, what's the correct answer? 168,000 adverse labor if rate variance, 108,000 favorable, and 400,000 adverse. So answer is D. So 400,000 part, don't worry, you are getting marks for that. But the rest, if you have calculated correctly, you are okay there, right? You are okay there. Answer has to be D. Okay, right. Then 1.4, this is about net present value. ABC Limited uses net present value for evaluation of its projects undertaken for the comparison of projects. For evaluation of its projects undertaken and for comparison of projects. Evaluation of projects undertaken, better to have a comma, but usually we don't put a comma in front of and. ChatGPT does that, but that is wrong. Okay, and for comparison of projects, which of the following is not true about the net present value related project evaluation? Okay. Two projects with two different durations. Okay. Okay. There's a request to share the answer sheet again. Let me do that. Stop sharing. Yes. I'm sharing the answer sheet. Can you all see? So this part is the answer actually. Answer actually is this part. Answer to the question is this part. But the other part I gave you, those are additional notes. Right? If you want to take down the formula, let me know. This is the answer. Answer to the question is this. Yeah. Not relevant directly for the answer. I have just done a calculation. Right? Just done a calculation here. But answer is this part. But if you need the formula part, okay. Right. Small problem. I'll hide this part so that all of you can see the entire thing. For the time being, I'll hide this part. More important for you is the formula as well. Yes. This is just an example, 50 rupees per unit and 5 rupees per hour. Can you all see the screen? Do let me know if somebody wants to see the answer. I can give more time. Those who want to take down the formula. Now remember, this is an easier approach that I am using, but I know you may have studied at various places under various teachers. So some are used to another method where you get the actual price into actual quantity, actual standard price into actual quantity. The difference is sales price variance. If you are familiar with that, don't confuse yourself. Please go by that method. That is also correct. That is an expansion method of this formula, because for some people remembering formula is difficult. So I don't know. It's up to you. But if you take this down, here MPV stands for material price variance, MUV material usage variance, LRV labor rate variance, LEV labor efficiency variance, variable overhead expenditure variance, variable overhead efficiency variance, fixed overhead, this is expenditure variance, fixed overhead expenditure variance, and this is volume variance. Under marginal costing, no volume variance. Under absorption costing only you get this. This part is the tricky part. So please remember that. Because sometimes the examiner asks this capacity variance and efficiency variance also. He asks. Sometimes only the volume variance with the per unit thing. Let me know once you are done. If somebody wants, can take a snapshot also, but anyway, this will be shared with you. So don't worry. And if somebody wants to take down the answer, just let me know. I'll move to that screen because it's a bit difficult to share both screens. Let me try. I think it gets cut off. So this has been very useful for me as well. This is one method that I followed those days when I was doing the exams. Especially I tell this to my students, follow this. Very easy. You won't go wrong. If you remember this, you won't go wrong. It's a matter of finding these figures in the sum. Just an example here. If you're not clear with any of these short forms, let me know. Abbreviations, short forms. Like if you're not clear, just let me know. To save time, I have written short forms for certain things. SP stands for standard price. SR stands for standard rate. AP actual price. AR actual rate. AH actual hours. AQ actual quantity. Okay. Shall we move on? Shall we move on with the questions? Okay. So this is the useful for 1.3. If any of you are taking down. Right. Are we okay? In the interest of time, I'll move on to the next question, but just let me know, or don't worry, I'll make sure that this is shared with y'all through the CS Sri Lanka exam division. We don't want to keep anything because we want y'all to make use of this opportunity and, be thorough with yourselves to, what do you call, for the exam, upcoming exam. Right. So, right. One ABC uses NPV for evaluation of its projects undertaken and for comparison of projects. Which of the following is not true about the net present value related project evaluation? Two projects with two different durations can be compared with the least common multiple period or annual equivalent cash flow method. Let's say you get project A with 4 years, project A 4 years, okay, and project B with 3 years. If you just compare NPV, I mean, A has 4 years to get you cash flows. No? A can become better, but what we are saying is go for least common multiple method. What is the least common multiple? In this case will be 12. It will be a bit difficult. I'll put 2 years here. 2 years and 3 years, 6 years. You repeat the cash flows of A for 6 years. Repeat the cash flows of B for 6 years, then check which one is giving the highest NPV. That is least common multiple method. Period. Annual equivalent cash flow method is okay, you get the cash flows for 2 years, average it out for annual equivalent cash flow, get the present value of that. It's like the annuity, not exactly the annuity, but annual equivalent cash flow method basically, right? The entire thing, the present value, you can use to annualize the cash flow, right? It's like getting converted to an annuity factor, right? So both these methods are useful when the project durations are different, right? Equivalent annual cash flow is something that you calculate based on the present value interest factor annuity. Present value interest factor annuity. Like 2 years one, you get the cash flows divided by the cash flows applied for the annuity factor, present value interest factor annuity for 2 years. And 3 years one, you applied for present value interest factor annuity for 3 years. So that's a method of comparing it. So this is correct. You can use it. This is one way of overcoming the problem of comparing a 10-year project with a 5-year project. Sorry. Part B, profitability index is the only consideration to arrive at the optimum solution with the highest return in the event of both divisible and indivisible projects within a single period. What is profitability index? Profitability index is like, let me go to my answer sheet for a short while for you to get some explanation on this, right? So linear programming one, I'll come later, right? This is for MCQ number 4, MCQ number 4, right? Talking about the part B, profitability index or PI, right, is equal to kind of how do I say that? Like you get it like if there's a divisible project, right? If it is a divisible project means capital can be divided. Like you have, let's say, for an example, project A, project B, project C, project D, right? Project A requires 100 million to be invested. Project B requires, sorry, let me put it in a proper order, right? Let me put it in a proper order. Yeah, like this. Project B requires 200 million, right? Project C requires 50 million. Project D requires 75 million, or let's say 150 million, right? So altogether, if you are going to invest in all the projects, you need 500 million. But let's say I have only 300 million. So I have a capital problem, right? I can't invest fully in all, or I'll have to be selective. So let's say this is the cash outflow, initial cash outflow. Initial investment, I would say. Initial investment. Right. Initial investment. Then NPV is also given to you. NPV is given, this one, let's say 40 million at the end of the period, right? And this one, let's say 60 million. This one, 25 million. And this one, 30 million. Now, if they are divisible, I can divide my 300 million here and do it. So profitability index we calculate, my dear students, NPV divided by the initial investment. And you can give it as a percentage if you want, right? For easiness, I'll make it positive, because otherwise usually this thing is negative because cash outflow, but I'll make it positive so that easy for you to understand this, right? So you divide 40 divided by 100. If you want, you convert it to a percentage. 40%, 30%, 25 divided by 50, 50%, 30 divided by 150, 20%. So you give rank. Rank number 1, C. Rank number 2, B, A. Rank number 3, B. Rank number 4, D. This is the deciding criteria. Okay. So my 300 million, what I'm going to do, right? If they are divisible, I can divide in proportions. Like I can say, okay, I invest 50 million here, 50 million I put here. Then 100 million I put here, 150 million gone. 200 million I don't have. I have 150 million I can invest here. If projects are divisible, you can do this. Okay. If projects are, I'm taking this example for you to understand only at the exam, you just think and tick the correct answer. Okay. Don't do these things. I'm just explaining you. If projects are indivisible, I have 300 million with me. I put 50 million for rank 1, that is project C. Okay. I put 100 million for rank 2, that is project A. 150 gone. I don't have 200 million, so I can't do anything here. So I'll have to go for project D. Because indivisible, you can't invest part, right? Partial investment is not allowed. You can't invest for a portion. So that's why I have to sacrifice B. So my question here is, the profitability index is the only consideration to arrive at an optimum solution with the highest return in the event of both divisible and indivisible projects within a single period. Now, both divisible and indivisible, my dear students, you can consider this. You can consider profitability index. But sometimes you can get a situation A and C are mutually exclusive. If they put a clause like this, what is this? A and C are mutually exclusive. If you invest in A, you can't invest in, C. If you invest in C, you can't invest in A. So you'll have to decide which one. I'll go for C. I can't invest in A. So if you get these kind of conditions, it's not the profitability index always. Okay. Profitability index is not NPV plus initial investment. Yeah, that is also fine. That is also fine. It's a comparison between basically, no, it's NPV divided by initial investment is what we are looking at here in terms of like, your profitability finally, right? So how much return we are getting, because NPV is after deducting the initial investment as well. So you can go for that also. That is also an option. Somebody get 140 to 60. That is also fine. That also gives you the same result. It will also give you the same result. Then you will get 140%, 130%, 150%, and 120%. No difference there. Not a problem. Even if you apply that one, that's fine. But NPV over initial investment is easier for you to make the decision. Okay? Right. So let me come back to the answer here. The question here, right? Yeah. So here, profitability index is the only consideration. No, we can't say only consideration, right? It's wrong. There can be things like mutually exclusive and all. Profitability index helps companies with limited investment capacity to maximize returns in the event of multiple investment opportunities available parallel. That is correct. Profitability index, when you have multiple investment opportunities with a limited investment capacity, if they are divisible, yes. Even if they're not divisible, yes, you can. In the event of NPV needs to be applied beyond an organization, including costs and benefits of a wider range, okay, economic net present value, ENPV, may be used. ENPV may be used in the event of NPV needs to be applied beyond an organization, including costs and benefits of wider range. Economic and net present value can be used beyond an organization like society, the government, or projects done by in a mass scale. If you are considering economic net present value can be used. So the answer is B. 1.4, the answer is B. Okay, answer is B. B is the answer. Right. Moving on to this one. 1.5, it's about the linear programming. Now, linear programming, you may get as a 10-mark question sometimes or like an MCQ. There had been instances where it has been given as an MCQ. A business firm manufactures two products, namely X and Y. A contribution per unit of rupees 500 and rupees 400 per unit are respectively earned by products X and Y. The graph given below depicts multiple limiting factors faced by the firm in an attempt to maximize its profit. The objective function of the firm to maximize the profit is given by 0.5x plus 0.4y equals 4,000. So here the key things are, the contribution per unit is given. Contribution per unit of X and Y are given. Okay. 500 and 400 respectively. Right. Graph gives the multiple limiting factors. Okay. An objective function is given. Objective function to maximize the profit is given. Okay. Right. So this graph is given to you with lot of details. So let me help you with this. Let me help you with this. Okay. Right. So here, objective function is given, my dear students, z equals 0.5x plus 0.4y equals 4,000. Now you are given in this case, I think I have moved this a little bit. So certain things have gone here and there. Yeah. So this has to come here. This has to come here. Okay. Other things are fine. So let me copy down this here. That will be easier. I moved my Excel sheet here and there, so something has happened. So to make it easier, I'll copy it down. Okay, I'll show the fourth question answer also. Copy that. Fourth question answer is B. Answer is B. I'll show what I have written on the sheet. I will show. Right. So I will get this here. Okay. I'm sorry because my Excel has moved here and there, so some of these diagram parts are not proper. Just yeah. So now here, yeah. Now it's much better. Anyway, I'll keep it like this for the time being. Yeah, it's much better. Okay. A, B, C, and D. Point D is here. Point D is here. Your objective function. This diagram is here. Right. Okay. So this is a diagram given to you. If anybody wants to go through this part, quickly go through it, the profitability index. Okay, profitability index part. Whenever I'm doing things to the Excel sheet, the Excel graph changes. But what is given in your paper is the Excel graph itself. Like, so refer the paper if you all have. Okay. So this one, I'll put it here in the chat. Save the time. I'll put it on the chat so that other students can continue with MCQ number 5. Okay. Right. So MCQ number 5, 0.05x plus 0.03y. Now the first one is actually 0.05x plus 0.03y. And this is another one. This is another one, 0.06 x and 0.08y. Now what you need to understand in this diagram, my dear students, okay, you have the objective function value given here, right? Objective function value given here and point D here, right? This A, B is actually here. B is actually here, okay? And yeah, this is slightly moved now. It has to be like this. I'll copy paste this diagram so that it will be clear for you. I'll copy paste this diagram because my diagram in the Excel has moved a little bit, right? Sorry about that. Please refer this one. Just forget about this entire thing. Forget about this entire thing and yes. I copied it from the question paper. Same thing. Same thing what I have drawn here is the question in the question paper, but if there are some movements, you'll be confused. So I'll just have this. Okay. Now here, point A, B, C, D, right? 4 points are there. This 0 point is also there. This green color part is the optimum solution, right? And you have your objective function also I have given here. Z equals 0.5x, 0.5y, 4,000. How does this come? If you don't understand, don't worry, right? Constraints are given. One is x equals 16,000. This is a constraint. Y equals 18,000. This is a constraint. This is one line is a constraint where 0.05x, 0.3y equals 1,200. And you have another one, 0.06x plus 0.08y equals 2,400. My dear students, in this diagram, if you carefully look at 0.06x plus 0.08y equals 2,400, that line is outside the optimum solution. So it's a redundant constraint. 0.06x plus 0.08y equals 2,400 is outside this. I'm referring to this blue color line that is not forming a part of the green color area, right? So that one is a redundant constraint. But if you take A, B, C, D and the 0 point, That's the optimum solution. So I am doing a corner point evaluation. Corner point evaluation, what do? You get the X and Y coordinates for A, B, C, D. Now at the exam, if you get the question like this, no need to draw the, what do you call, no need to draw the diagram, or no need to draw the graph, right? It's already given, but you need to do this part. Now, A means A equals 0, X value is 0, Y value 20, Y value is 18,000. Y value is 18,000 here. Y equals 18,000. So you apply the objective function value Z equals 0.5x into 0.4y. That is 0.5 multiplied by 0 plus 0.4 multiplied by 18,000. Okay. 0.5 into 0 plus 0.4 into 18,000. You get 7,200. Same way, point B. Now, point B, you don't know. Point B, you don't know. You'll have to find out. How to find it out, right? How to find it out. Now, what do you have here? Y equals 18,000. Okay, here I'm helping you, right? Point B, when you want to get, one point is basically Y equals 18,000. The other line is 0.05x plus 0.03y equals 1,200. Now here, these are the constraints. One constraint is 0.05x equals 0.03y equals 1,200. At x equals 0, how much is y? At y equals 0, how much is x? If you want, you can find out, but no need to spend your time on that. 0.06x plus 0.08y equals 2,400. At x equals 0, how much is y? Y equals 0, how much is x? If you're drawing the graph, you need it. Y equals 18,000 is a constraint. X equals 16,000 is a constraint. How do I get the point B? Let me help you on that, right? Point B is the cross-section point of y equals 18,000. One constraint is y equals 18,000. The other constraint is 0.05x plus 0.03y equals 1,200. Okay. Now, what do you have to do, my dear students? Put, instead of y, you can put 18,000. Instead of y, you can put 18,000 equals 1,200. Simplify this. 0.03 into 1,200. Sorry, 18,000. Simplify this. 540. 540 equals 1,200. Right? 540 equals 1,200. So 0.05x is equal to 1,200 minus 540. How much is that? Or if you want, you can apply the calculator. You have the simultaneous equations if you know how to solve it. First one is 0.05x plus 0.03y equals 1,200. Next one, x value 0, y value 1, 18,000. That way also you can easily do. If your scientific calculator is capable of solving simultaneous equations, if you know how to do that, please do this. So x is equal to 660 divided by 0.05. 660 divided by 0.05. 13,200. That's how you get this. That's how you get this. Y value 18,000, X value 13,200. Then you apply 0.5 into 13,200 plus 0.4 into 18,000 gives you that answer 13,800. Just double check that. You get the objective function value for point B. Point C also you'll have to find out. Point D anyway known, X value 16,000, Y value 0. That is easier. 0.5 into 0 plus, sorry, 0.5 into 0 plus, sorry, 0.5 into 16,000 plus 0.4 into 0, 8,000. This one also you need to find. I'll help you on that. Point C, how do you find? Same way, point C is cross section of X equals 16,000 and that line. Same line. X equals 16,000 and the same line. Same line. Okay. So substitute X value. 0.05. X value is 16,000 plus 0.03 Y equals 1,200. 0.03 Y equals 1,200. So 0.05 into 16,000 means 800. I'll just keep that bit away. These are all kept a bit away, but they are, relevant answers for you. Okay. So 800 plus 0.03 Y equals 1,200. Equals 1,200. Right? So you have to spend a bit of a time in this question number 3 and question number 5, which is why you need to accelerate on the other areas. Okay. Right. So here, I'll get a bit more space here. Yeah. So then 0.03 Y is equal to 1,200 minus 800 means 400. So Y equals 400 divided by 0.03. 400 divided by 0.03. 13,333. Otherwise, if you all know how to solve simultaneous equations in the scientific calculators, 1x plus 0y equals 16,000. 0.05x plus 0.03y equals 1,200. Solve it, you get this. X value how much, Y value how much. X value is 16,000, Y value is 13,300. Okay. So you just apply this and see 0.5 into 16,000 plus 0.4 into 13,333. So out of these things, the highest value we get 13,800. That is the optimum solution. So once you get the optimum solution, you know the binding constraints are the two lines that form the optimum solution, right? Y equals 18,000 is a binding constraint, and this line 0.05x plus 0.03 Y equals 1,200 is a binding constraint. Binding constraints actually for the two constraints that form the optimum solution. Binding constraints are the two constraints that form the optimum point. Okay. Redundant constraints are any constraints totally outside the feasible region. What is the feasible region? The green color area. Feasible region are the combinations of products we can manufacture as an organization and sell. So if you note it down, what are the answers? Answers will be, which of the following statements are correct? Be 0.05x plus 0.03y equals 1,200 is a binding constraint. Is it correct? Yes, it is correct, right? Is a binding constraint. 0.06x plus 0.08y equals 2,400 is a redundant constraint. Yes, it's outside. It's outside the what you call feasible region. Yes, that is also correct. Optimum combination of x and y are 16,000 and 13,333. No, 16,000 and 13,333 are point C. That is not correct. That is not correct. Optimum combination is x equals 13,200, y equals 18,000. Yes, that is correct. Now to do that, you need to do the corner point evaluation and identify the optimum point. If you know the optimum point only, students, you know the binding constraints and the redundant constraints. So the answer is 1, 2, and 3. Sorry, 1, 2, and 4. 1, 2, and 4. Answer is D. 1, 2, and 4 are correct. Answer is D. 1, 2, and 4 are correct. Roman 1, Roman 2, and Roman 4 are correct. Okay. If any of you are taking this down, quickly take down. You can move on to the next question if you are okay. I'll give you a couple of minutes. I hope his screen is visible. Okay. I know this linear programming is not a very famous area at the exam, but it's in the syllabus. You might get something like this. It can be an MCQ or it can be a part of a 10-mark question where like something less than 10 marks will be allocated or maximum 10 marks will be allocated. It can. Very rarely you will get one for 20 marks. I'm not too sure, right? Because this part comes under long-term decision making. The project evaluation is also in the same section. Linear programming is also in the same section. And there are other things like, transfer pricing and divisional performance is also in the same section. So little bit less weightage for linear programming now, but it can come. And as per the examiner, last time, it's one of the areas where students have not performed really well. Shall we move on to the next question if you all are okay? So here the answer is D, right? Here the answer is D. Okay. Next one. Which one of the following is not a characteristics of the total quality management? Is raising hand. Okay. Right. 1, 2, and 4. Which one of the following is not a characteristic of total quality management? Total quality management. TQM, total quality management, aims towards an environment of zero defects and zero wastage at minimum cost. Correct. This is correct. Right? Cost of preventing mistakes is less than the cost of correcting them once they occur. Okay. Sometimes there can be an acceptable tolerance limit for the level of quality. Total quality management requires an awareness by all personnel within the organization and the supply chain. That is also correct. Everyone in the organization must be aware. Okay. Yes, you are asking, explain how to get the, okay, I'll quickly get back to that. Two students are asking it. Yes, let me, sorry, I just saw the, your, Let me know whether you can see my answer sheet. Yeah, I think my answer sheet is visible, right? Okay. Okay. Now you got you know how to get the point B XY values and point C XY values. No, that I explained. No. Now this objective function value, my dear students, is given as 0.5x plus 0.4y equals 4,000. They have drawn it. You put X value here, something is like 10,000, right? X value 10,000. So like X value 8,000. Actually, there's a slide there. It has to be 8,000 here. And Y value maybe 10,000, like slightly higher than this thing. They have given a value 4,000. You ignore that. Now I have put objective function value as Z equals 0.5x plus 0.4y. How do you get these values? For A, X value is 0, Y value is 18,000. I calculated. Okay. I calculated. Right? To this one, 0.5x plus 0.4y. Right? 0.5 into the X value is, now if you take the A, 0.5 into 0 plus 0.4 into 8,000, 18,000. Do you understand? How much is the answer? 0 plus 0.4 into 18,000, 7,200. This is the answer. Next one, I got these coordinates. So 13,200 is the X. How do you get that? By cross-checking point of Y equals 18,000 and this line, 0.5x, this line. Unfortunately, I can't highlight or I'll just try to draw. Yes. Cross-section point of this one and this one. This is point B. You understand? Okay. So I believe you understand how I get by solving these two, how I get this value, 13,200. 13,200 comes here. Right? Right? So 0.5 into this X and Y coordinates, my dear students, we are applying for that objective function. 0.5 into 13,200 plus 0.4 into 18,000. Clear? You get 13,800 because all are 13,000 and all. It might complicate. You can get an answer like this at the exam. 13,800. When you solve this, 0.5 into 13,200 plus 0.4 into 18,000. Just check that. This is what I have written here. See, you got the coordinates by solving X equals 16,000 and that line. You get Y value 13,300 and X value 16,000. That's what you got here, right? That's what you got here. I'll use a different color to demarcate it. When you solve this, 0.5 into 16,000 plus 0.4 into 13,333. You get 13,333. Same way this one. This one I didn't write because I thought you all can understand. 0.5 into X value is 16,000 plus 0. Y value is 0. 0.4 into 0. Y value is 0. 8,000. Now, what is this objective? Maximizing your profit, maximizing your contribution, total contribution. If I manufacture the combination at A, only 18,000 units, I can earn a contribution of 7,200. If I go for the combination of B, corner point evaluation talks about one of your corner points will be the optimum points. ISO profit line talks about this objective function line moving up. So I have used the corner point evaluation. If I manufacture 13,200 of X and 18,000 Y, total contribution will be 13,800. Okay. Point C, if I go as my combination, 16,000 X and 13,333 Y, 13,333 will be the total contribution. And only 16,000 X You get 8,000 as the contribution. So which point gives you the maximum contribution is maximizing your profit and maximizing your contribution. So point B is the optimum solution. Are you clear with that? I believe you are clear with that. Right? Shall we move on? Okay. Yeah, thank you so much. So then we'll move on to the next one. Yes, cost of preventing mistakes is less than the cost of correcting them once they occur. Sometimes, so this is a tricky one. B is a tricky one. C, sometimes there can be an acceptable tolerance limit for level of quality. Total quality management talks about, my dear students, okay, total quality management talks about, remember 100% level of quality. 100% level of quality. I'm sorry, I can't write it like a whiteboard here. Okay, 100% level of quality. Please remember that. Total quality management. That means zero defects, zero wastages, zero repairs, zero rework, zero recycling required. Recycling can be done as a different story. Zero rework, zero repairs, zero defects, zero wastages. Sometimes there can be an acceptable tolerance limit of level of quality. Wrong. Wrong. This is not allowed. Level of quality is 100%. Right? Right. So then part B, the cost of preventing mistakes is less than the cost of correcting them once they occur. Once they occur, cost of preventing mistakes is less than the cost of correcting them. Preventing mistakes is better than correcting them. This is a thinking, this is a tricky one, right? Usually it's complicating, I know. So the answer is C. Answer is C. Okay. Sometimes there can be an acceptable tolerance limit of level of quality. No. Level of quality, tolerance limit is 0. Okay. It's a bit tricky one. If you understand the concept of TQM, then you have to see, because sometimes you might get two answers very much close to the correct answer, but you have to think very carefully. Because whenever you are talking about cost of quality, cost of prevention and cost of correction is there, but we have to incur a cost anyway. You can't avoid the cost of quality. But what are you going to do? Total quality management is that you arrive at the optimum level of quality by minimizing the cost of correction, right? Cost of correction 0, cost of prevention maximum. Yes, if you have any question, you can ask. Are we okay? Right. Shall we move on to the question number 7? Because I know that time is running up. We'll quickly work out wherever Don't worry, other ones I'm not going to spend too much of time on. Yeah, I have written all the answers, but MCQs, some I have written the answers, but some are logically you have to think and get no. That is why I spend a bit of more time. Which of the following is not an advantage of zero-based budgeting? Now, what is zero-based budgeting? Zero-based budgeting. You think from the zero, scratch. What is the alternative one? Incremental budgeting. Other type of budget is incremental. Okay. Incremental budget, you look at the past years and based on the past year's trends, you prepare the budget. Incremental. The opposite one, right? Zero-based budgeting, you forget about the past, you question everything. Why are we selecting the raw material A instead of B? Why are we not going for the lowest price? Why are we going for supplier A, not the supplier B? Everything you question and you prepare the budget. Long-term benefits may be emphasized detriment to the short-term benefits. Not an advantage of zero-based budgeting, right? Long-term benefits may be emphasized detriment to the short-term benefits. We'll look at that. Identifying and removing inefficient, obsolete operation. This we are doing. Identifying and removing inefficient, obsolete operations. Responding to changes in the business environment. Okay. If there's a change happening, of course, you think from the scratch. Yes, we are have to do that. Increasing motivation. Shall I'll just erase this one and put the tick the other side, because otherwise some people might think, okay, this is the answer that I'm not. I'm just saying whether it's correct or not. This is correct. This is also correct. Okay. Increasing motivation of employees while challenging the status quo. Status quo you challenge. Now, if you're not sure, just move on to zero-based budgeting in your study pack, right? These are all theory, Theory is explained very well in the study pack. Please refer it. Incremental budgeting versus zero-based budgeting. Okay? Advantages, disadvantages, all these things are there, right? So here, we talk about identify and remove inefficient, obsolete operations. Yes, we do. Avoid wasteful expenditure. Increases motivation. We do. Respond to changes in the business environment. The ZBB document provide in-depth appraisal of operation. Challenges the status quo. More efficient allocation of resources. Disadvantages. Short-term benefits may be emphasized to detriment of the long-term benefits. Right. Okay. I think that has to be, yeah. So that's a disadvantage. So not an advantage, long-term benefits may be emphasized, detriment to short-term benefits. There's nothing like that is happening here, right? Here, short-term benefits might be emphasized, detriment to long-term. What do you mean by that, my students? Maybe we'll select the lowest cost raw material supplier, but his quality may be poor, right? So short term, you might be okay. You are selecting the lowest raw material cost and your cost is going down. But you haven't considered some other aspect. Or maybe you are selecting supplier X, but if you select supplier Y, he will give you two types of raw material together. But supplier X gives you only one. But based on the cost, we might go for X. Now, long-term benefit, we will forget about and we'll focus on the short-term benefits. So this is wrong. There's nothing called long-term benefits may be emphasized between the short-term. It's actually short-term benefits emphasizing. That's a disadvantage. So the answer is A. I know a bit tricky. Unless you have gone through these advantages and disadvantages, you don't have to by heart everything. But if you have read it, if you can remember it, you should be able to answer something like this. But remember them, because this time your paper, they can ask zero-based budgeting in a 10-mark or a 20-mark question as a part and ask some of the advantages of zero-based budgeting. So you need to remember. Or maybe one or two disadvantages of zero-based budgeting, you will have to remember. Please revise that. Identify which one of the below is not a principle of activity-based budgeting. What is activity-based budgeting? Just like activity-based costing, you look at recognizing your overheads based on the work done, based on the activities, based on the work done, right? And you put all your overheads into a cost pool and recognize. We don't use the word absorb. It's the new generation of absorption. Like you recognize based on the work done or the levels of activities. All activities are value adding to the organization. Can we say that? We don't know, right? Activities drive cost. Part B, activities drive cost, and the aim is to control causes or drivers of cost rather than the cost themselves. Rather than the cost themselves. Most departmental activities are driven by demand and decisions beyond the control of the departmental heads. Okay. Part B is correct. Activities drive cost and aims to control the causes, drives of cost rather than the cost themselves. Most departmental activities are driven by the demand and decisions beyond the control of the departmental heads. We'll come to that. Continuous improvements can be achieved through additional focus on cost drivers, quality of activities undertaken, and the responsiveness to change, etc. Now, if you read activity-based budgeting, right? If you have studied your theory, you may be having tutorials or whatever. Or if you just go through the study pack, right? So please remember these theoretical parts. Everything is properly explained in the study pack. Please remember that. Activities which drive cost aim to control causes drivers to cost rather than cost themselves. That was there. Okay. Most departmental activities are driven by demands and decisions beyond the immediate controls of the manager. So that is also there. Traditional finance measures of performance are unable to fulfill the objectives of continuous improvements. Okay. Continuous improvements can be achieved through additional focus on cost drivers, quality of activities, and responsiveness to change. It's there. Right? This part is there as it is. Right? So I have extracted from the study pack here. Okay. Right? Not all activities are value varying, so activities must be examined to split up according to their ability and to add value. So this is wrong. It's also correct. The answer is A. All activities are value adding. We can't say that. Consider the following statements related to decentralization, transfer pricing, and divisional performance measurement. You are talking about the decentralization. The weakest form of decentralization is the cost centers, while the strongest form is investment centers. Yes, that is correct. If you want, please refer the theory on decentralization. Variance analysis and efficiency measures can be considered as KPIs for a cost center. Yes, as a KPI for cost center. Let me just share that part also with you. Decentralized organizations. Decentralized, page number 268, it says. Okay. Yeah. It's here. Yeah. On decentralization, general divisional decentralizational structure, right? So advantages are there, disadvantages are there. Okay. And cost center, if you take performance measurements, variance analysis, and efficiency measures, that is correct, right? Investment center, head office has to, so this is correct, KPIs of a cost center, right? And somebody can say cost center is the, you can't actually say weakest or strongest, but preferred. In terms of decentralization, yes, cost center is the weakest. This one is the strongest. What you call investment center is the strongest. Cost center, revenue center, profit center, and investment center. Okay. Then head office has to prevent any dysfunctional decision made by divisional managers while ensuring retention of goal congruence, where all divisions work towards the same target and benefit of the organization. Goal congruence is where all division works towards same target and the benefit, and has to prevent a dysfunctional division means suboptimal decisions. Dysfunctional divisions also known as suboptimal decisions. So head office always tries to prevent any suboptimal decision made by a manager of a profit center or an investment center where they have the authority to do so. Decentralization may cause top management to lose control over the organization. That might be mitigated through a good system performance evaluation. This is correct. Okay. So answer is all four are correct. All four are correct. Okay. Answer is all four are correct. So if you have studied the theory on decentralization, you can answer for this. And last question on the MCQ. Consider the following statements about the transfer pricing. Minimum transfer price should be the sum of supplying division's marginal cost and opportunity cost of the item transferred. Okay, right? Sum of supplying division's marginal cost and the opportunity cost of item transfer. Okay. You see, maximum transfer price is the lowest market price at which receiving division could purchase the goods or services from outside, less any internal cost savings such as packing and delivery, right? Market price minus any internal cost savings such as packing and delivery. Minimum is the variable cost in transfer pricing plus any opportunity cost applicable to the supplying division. Like it's like this, my dear students. Now, if you are like if you are doing this supply, I'm having a transfer pricing question. When I come to that, I will explain. Okay, if you are like if you are basically say like I have a here, you have, let's say, supplying division is A, receiving division is B. Okay, right? So here minimum we have to give minimum transfer price. Minimum, if now in this case A is supplying B, A is supplying the raw material required for B, right? Yeah, like this, right? Minimum transfer price must be equal to the variable cost. Maximum transfer price must be equal to the market price. This is on a hypothetical scenario where there's a perfect competition available, right? But here, minimum transfer price, variable cost plus, if there is any opportunity. Now, let's say supply division, this is the product X they are selling here. Let's assume product X can be sold in the outside market. There's a ready demand available. So that you are sacrificing and giving it to B. That's an opportunity cost. So we say minimum transfer price is not just variable cost. It's equal to variable cost if you don't have an outside market. plus any opportunity cost can be the contribution forgone. Example, contribution forgone if if an outside market is available. If an outside market is available. If an outside market is available for product X. Right? So minimum transfer price has to be variable cost plus opportunity cost. Maximum transfer price, theoretically, we say it is market price, lowest market price it can be. But practically, from the market price, you can deduct any selling cost. Selling and distribution cost not applicable. If any selling and distribution cost is not applicable, you can remove. Let's say for an example, when division A is selling the product X outside, it has a package cost. Package cost is 5 rupees per unit. That you don't have to charge from division B. Division B might say, we don't want this pack, you just deliver us the goods. Okay. So that kind of an avoidable cost, the benefit has to be given for the receiving division. So with that understanding, let me, okay, somebody has asked tolerance limit. Tolerance limit means kind of like how much you can tolerate, a tolerable number of defects, tolerable number of rework. That's not allowed in total quality management, right? No tolerance. Zero tolerance is total quality management. So this is correct. And maximum lowest market price at which receiving division less than internal cost. This is correct. Dual transfer pricing can be a solution to avoid a division making a suboptimal decision due to unfairness caused by certain transfer prices. Certain transfer prices may not be perfect on division A or sometimes may not be perfect on division B. Division B might think, why are we buying at this transfer price? We can go and buy it from outside. Company cash goes out. Or division A is thinking, why are we selling it to division B? We can sell it at a higher price at the outside market. We'll go for the outside market. So then division B is not getting enough material for their production. Company is losing. So to avoid that, you charge one transfer price for division A, one transfer price for division B. When you are consolidating, you just ignore the transfer revenue and the transfer cost. You can't set off. They're not equal. But that's one option available in transfer pricing. Offered two different prices for the receiving division and the supplying division. Okay, right. It is impossible to apply transfer prices when there is a lack of information on costs and revenues of individual division. Impossible to apply transfer prices when there is lack of information on costs and revenues of individual division. Right. Okay. Now here, something is there. Anyway, it is impossible to apply transformation when there is a lack of information. Cost and revenue division is wrong, right? It's wrong. Why? Even if you don't know much, all the information, you may not know the fixed overheads, you may not know the, all the cost structure and everything, but minimum variable cost is known, you can look at that. Or the market price is known, you can look at that. Maybe the receiving division, all the costs you don't know. Division B, you don't know the cost structure and everything, but you know the market price is available and you know the variable selling cost from A to outside market. So you don't need to know all the information, but still you can apply transfer prices. So answer is incorrect, no? Which of the above is incorrect? 4 only. All others are correct, right? But you don't have to know all the cost and revenues of both divisions for you to apply a divisional transfer price. Are we okay up to that point? Any question? Anything I miss? Sorry, sometimes I don't see your questions. Okay, please share the Excel sheet. We'll do. I'll quickly share the Excel sheet. In the meantime, if you all had any question, please let me know. I'm sharing the Excel sheet again. I think you wanted this divisional performance measurement part, no? Right? The supplying division A, supplying division A, okay? Supplying division A and receiving division B, right? It's just an example, but don't worry, I have given a comprehensive transfer pricing question. There again, we will come across this. This MCQ I gave just to test your basic theory on transfer pricing and to balance the weightage of the paper as well. But please don't blame me, as at the beginning that I told you. If you are not getting the same areas for 20 marks, if you are not getting the same areas for MCQs, please don't blame me. This is just for you to practice only. Actual examiner, he will decide, okay, what are the areas that will come for the paper, but you need to be ready for anything. But of definitely some out of these areas should be there, right? Because we look at the paper pattern, the weightage, everything. Shall we move on to the next question? Next question is about, yeah, transfer pricing or yeah, and divisional performance. Divisional performance. Okay. I'll try to share my screen. That will be easier. Then to whichever the screen I'm going, you should be able to see. I don't know that function, whether it's working. Yeah, I'll share like this. Yes, you want the Excel sheet again? I can see somebody has raised the hand. Okay. You want the Excel sheet? Okay. If you have a question, please post. I can see one person raising the hand. Yes. You can ask any question if you have, or you can put me on the chat. You didn't get the Excel sheet? I'm sharing. Wait. What are the key lessons for target of exam paper? I don't like to predict the paper because as I told, I'm not the examiner. Examiner has the right to do that, and it's CS Sri Lanka's property. Only thing what I can say is this: you look at the entire syllabus, and there is a way. I can share you this. I can share you this. Okay. Um, Let me. I don't want to guess anything, or that please don't expect that from me, right? But let me share this. Can you all see my screen? Am I obstructing anything? I can see one person keeps on raising. Why Pereira? You want to ask a question? You want to ask a question, Pereira? Or is it a mistake? Okay, we'll move on. We'll move on. What I was trying to say, somebody asked me about, when calculating maximum transfer price, we have to deduct opportunity cost. No, no. Dual transfer price. Okay, dual transfer price. I'm coming to that. I'm coming to that in. I'll explain that with an example. Okay, not here. I'll explain. Okay, dual transfer price. Since you're asking, let me explain it here. One person is asking, when calculate maximum transfer price, do we have to deduct opportunity? No, no, no. Opportunity cost is what in Sinhala we say avastita pirivaya. Economics you study contribution for what? Let's say you take one decision, because of that you lose something else. That is opportunity cost. Now here, division A decides to sell the product X to B, and it could have sold outside at a higher price. You are sacrificing some contribution. That is the opportunity cost. That is the opportunity cost in that example. How do you get a dual transfer price? Let's say you give one transfer price. Division A sells at transfer price equals 10 rupees per unit. Right? Or I'll put an example here. Variable cost is 5 rupees. If you are selling outside, this is for A. This is for A. If you are selling outside, contribution per unit is 3. So ideally the selling price is 8 rupees. But let's say for division B, this is division A. Division B, you are doing a transfer price of, let's say you are charging the minimum transfer price, variable cost, that is only 5. So the problem is, now division A, the variable cost is 5. We are selling to the division B. We don't get a contribution, no motivation, right? So ideally the recommended transfer price in this case is, recommended transfer price will be 5 plus 3 equals 8. That is variable cost plus opportunity cost. But division B might say there's another supplier. There's another supplier offering at 6 rupees or 7 rupees per unit. Now, why do I pay 8 rupees and get it from A? I will go to this outside supplier and get it as 7, a similar product. This is not a perfect competition. In a perfect competition, it won't happen. But practically, we have oligopoly, monopoly, monopolistic markets. Different markets are there. Right? So there's another supplier offering at 7 rupees. So division B might go for this one. Division B might go for this one. Okay. And then it will be like a suboptimal decision. That is a suboptimal decision because practically, if we are producing in-house, the company cost is 5. Now, when we are buying from the supplier at 7 rupees, the company cost is 7. Overall company, that is not the best thing. Overall company goal congruence is violated, but division B is making a dysfunctional or a suboptimal decision here to go for it. To avoid it, what we can do, to avoid this, suboptimal decision, what you can do is, for A, in books of A, you recognize a transfer price equals 8. In the books of division B, you recognize transfer price equals 6. So if you are recognizing at 6, you won't go for this outside supply at 7. But here, you are not losing for division B also. But they won't be contra entries. You can't set off the transfer revenue and the transfer cost. So when you're consolidating, just that's a complication that you get in dual transfer pricing. Ignore transfer revenue for A and transfer cost for B. This is what we call the dual transfer pricing. Okay, dual transfer pricing is this. Clear? Shall we move on to the next question? Those who have done that, please read the question number 2. When the wholesale division of ABC Limited has been processing wheat flour for its bakery, I'm keeping the Excel sheet shared for those who want to take down. The others can go through the question number 2. I assume you have the paper with you, right? If not, I'll quickly share the paper while giving time for other people to write down. The wholesale division of ABC Limited has been processing wheat flour for its bakery division that uses wheat flour to be converted or to bread and sold in its bakery outlets. ABC has recently started a retail division that sells packeted wheat flour at supermarkets and local grocery shops. While I'm doing this, my students, if you all haven't had your dinner or if you all want a short break, please have that time come, right? Because I can't give you an official break because everyone will be like, at different times. But if you all want a short break, please feel free to have it. If you all need, I can give you a 5 to 10 minutes break, but I value everybody's time, so we'll continue. I hope that is okay. But just let me know if you all need a short break or anything can be given. I'll come back to the paper. Okay, I think you are seeing the paper. Its bakery division that uses flour to be converted to bread and sold in the bakery outlets. ABC has recently started retail division that sells packeted wheat flour at supermarkets and local grocery shops. The proposed budget for the upcoming quarter is given below with the approval pending from the management. Note: one loaf of bread requires 400 grams of wheat flour. 300,000 loaves at 150 each is the sale. 130,000 kilograms at 200 per kilogram. External, they can sell it at 26,000. Right, 120,000 kilograms of 120 to bakery division. Bakery division, they are transferring wholesale division. Okay. And wheat flour cost 120,000 kilograms at 120 per kilogram. For this, you see the transfer revenue and the cost are equal. 250,000 kilograms at 100 rupees per kilogram for wholesale division. Other variable costs, yeah, 6,000 and 5,000. The contribution, the fixed cost is given profit. The manager of wholesale division believes that he could increase the profits of the division by selling more quantity of packeted wheat flour at outside market at the same price of 200 rupees per kilogram. There currently sufficient unsatisfied demand exists. Currently, the management of ABC has proposed the wholesale division manufactures and supplies the wheat flour to bakery division, ABC has proposed the wholesale division, manufactures and supplies the wheat flour to bakery division at a variable cost of 120 per kilogram. So this is what we are having here, right? Wheat flour 120 per kilogram. Okay. However, at present, wholesale division is manufacturing the maximum capacity of 200,000 per kilograms per quarter. Is wholesale division proposes to reduce the quantity of flour provided to the bakery division. If the bakery division is to purchase wheat flour from outside the market price, is rupees 200 kilo. If bakery division wants wheat flour outside market it's available at 200 rupees. So that is higher. Okay. Maximum unfulfilled demand for wheat flour is in outside market would be more than the current production capacity of wholesale division. Unfulfilled demand is, that means enough demand is available per quarter. The management of ABC wants quantity provided to bakery division from the point of view of ABC as a whole. No changes will happen to other variable costs, right? Because of this decision. Okay. Now I'll, like, without wasting much of your time. Okay, somebody's asking answer for MCQ 10, please. I have given it. Okay. MCQ 10, the answer was B, number 4 only. Roman number 4 only. Yeah, incorrect. Okay, right. Question number 2. Right. This is the present situation. I have got it from the what do you call the given sum by the, like, in the question 300,000 and 150, and the sales for wholesale division. ABC company as a whole, you see, this transfer revenue 14,000 is not coming when you are consolidating, and wheat flour cost not coming under consolidating. Other things are there, so other variables. So this is the present situation. So at present, 14,600 is the profit made by bakery division, 5,400 in rupees thousands, 5.4 million is the profit made by wholesale division, 20 million is the overall profit by the group. Okay. If the entire capacity of 250,000 kilograms wholesale division is sold at outside market, because wholesale division, now in this case, my dear students, wholesale division is providing for, wholesale division is providing goods for bakery division, wheat flour. You understand? Receiving division is bakery, right? Okay, right. So here, when you do that, now there's a ready market available outside also. Outside also you can sell. Okay, outside market also. I always recommend available for more than 250,000. If you want, you can say, I don't want to sell any unit to bakery division. All kilograms of wheat, I'm going to sell it in the outside market. Can be done. If entire Always draw this diagram even when you are doing an exam question for transfer pricing. Please draw this, it will be very clear for you. If the entire capacity of 200,000 kilograms of wholesale division is sold at outside market, and a bakery division buys wheat flat 150 kilograms from external supplier, there's an external supplier ready to give it at 150 per kilogram, right? Okay, so if the bakery division is to purchase wheat flour outside market, is price is 200 per kilo. Hold on. At present, wholesale division manufactures maximum quality. Therefore, it is to increase the external sales. Wholesale division proposes to reduce the quantity of flour provided to the bakery division. If the bakery division is to purchase wheat flour from outside the market price, from outside, comma, the market price is 200 per kilogram. Let me check. Yes, sorry, not at 150, it's 200. My mistake here. Question is correct. Question is correct. I have erroneously typed 150. Recording, I'm not too sure whether it's going to be available. Institute of Chartered Accountants only will know. Right, but as I told, if you all want to get a break, just let me know. I can give you a quick break, but we have to discuss few more questions. So I won't be writing all the answers because I have a set of answers prepared and we'll be sharing these answers. I'm just explaining. Right? Now here, what happens is this particular, what do you call, the bakery division, right? If you are like selling entire thing also, see the difference. Earlier, you were selling wholesale division 120,000 at 100. Now this is gone. All 250,000 sold at 200 rupees outside market. And wheat flour cost, they are buying at 24,000 outside market at 200 rupees. Clear? Not at 150, it has to be 200. The question is 200. Other things are same. This 45,000 bakery division sale is there. These other variable costs. All these things are there. Nothing will happen to them. So these two have changed. Now what has happened? Profit for bakery division comes down to 5,000. There's a decline by 9,000. Earlier it was 40,600. Now it has come down to 5,000. A decline of 9,600. Earlier, wholesale division was making a profit of 5,400. But now it's 15,000. Now it's 15,000. Right? I'll be sharing. I'll make sure that Chartered Accountants Institute will be sharing this answer sheet. Right? I'm not too sure about the recording. Probably, I don't know. Right? But you will be getting the answer sheet, so don't worry. But just try to understand the explanation. So here the change happened, my dear students. Earlier, wholesale division was partly selling outside, balance part to inside bakery division. Now they sacrifice, they don't want to sell it to bakery division, entire thing sold outside, they make more money. Their profit gone up by 9,600. Whereas wheat flour actual production cost is very much less, but we are buying at a higher price of 200 rupees. So bakery division has to pay money. Company also has to pay money. Nothing gets cancelled off. Company also has to pay money, but at the end of the day, no change in the company profit, so it doesn't matter. But bakery is losing, wholesale is gaining. Okay, so change in profit will be bakery division reduced by 9.6 million, wholesale division increased by 9.6 million. ABC company, no overall profit change, because they are asking, the management of ABC wants to evaluate the proposal of reducing the quantity of product to bakery division by wholesale division that forces bakery division to purchase flour from the external market. From the viewpoint of bakery division, bad, their profit comes down. From the viewpoint of wholesale division, their profit comes up. Company ABC as a whole, nothing, no change happening to the overall profit. Part B, they are asking, discuss the best course of action. Discuss the best course of action. Okay. Discuss the best course of action regarding the transfer price from the viewpoint of ABC company as a whole to increase the profitability of wholesale division while not making a suboptimal decision that would cause an unwanted cost to the overall company, right? So from the viewpoint of ABC company as a whole to increase the profitability of wholesale division while suboptimal decision, while not making a suboptimal decision, right? So what do we have to do? Okay, let me go back to the answer sheet. Here what happens, my dear students, to avoid the suboptimal decision of purchasing from external market at 200 rupees, provide a markup for the variable cost of wheat flour production for the wholesale division. Because right now the variable cost is 120. So by selling inside, they don't get much. They don't get anything. Variable cost is 120. Provide a markup for that. That's the recommendation. Where the transfer price would be between 120 and 200. Example 150. I have taken an example 150, but you can take anything between 120 and 200. So in that case, they are making a profit. They are making a contribution somewhat 120,000 at 150. You see the earlier scenario. Earlier at the beginning, they were selling at the variable cost. That's what made them to sell the entire thing outside. Now they are getting something 120 plus 150. And the same will be the transfer cost to bakery division. So what will happen here? Bakery division getting 11,000. Not so good as earlier, but not so bad as part A. But wholesale division getting 9,000. Not so good as part A, but not so bad as part B. Yeah, like not so good as, not better than the present situation, but not so good as part A scenario, right? Overall company, no change happening. Now see, the recommendation is this, where transfer pricing would be between 120 and 200. Anything between 120. I have worked out this answer for 150, but if you work it out to 160, no problem. Because overall company, whatever the transfer revenue and the transfer cost will be setting off at consolidation. So nothing to worry on that. Transfer revenue and transfer cost will be setting off. You just recommend something between 120 and 180. Are you clear up to that point? Anything not clear in this question? I'm more than happy to help. If not, we can move on. So this is a 10-mark question, not a very difficult question. At the exam, I recommend. Somebody asked about the exam, the approach and all. Okay. This has been the weightage for, I hope you all can see the screen. Let me stop share and reshare. Stop share and reshare, yes. Okay. This has been the pattern from December 2020 up to now. There are areas. A, cost management means where you get the target costing, Kaizen costing, TQM, business process engineering, value chain, supply chain, just in time, those parts. Planning and control, many standard costing, variance analysis, budgeting, beyond budgeting, and what do you call, you get this balance scorecard under part B. Part C, you get, there are two aspects. Yeah. Pricing also comes under part B, right? Transfer pricing and divisional performance, then long-term decision making, project evaluation, linear programming, limiting factor, those things are coming under part C. Risk and uncertainty, you get the decision trees, payoff tables, the probabilistic and non-probabilistic decision making, TARA framework, that part, and working capital management, inventory management, cash flow management, and what do you call creditors management and debtors management. Working capital management you get, right? Cash management, debtors management, and inventory control. Very rarely they test the suppliers, the creditors management as well. So these are the percentages in the syllabus as per the study pack. Okay, right. You see the pattern. All the years, part A has been around 20. Some years it has gone up to 22. 1 year it has gone up to 18. Slight variation. Part B 25%, 26, 28, 25, 26, 28, 24. Since the syllabus change, you have that, right? Yeah, yeah. I'll come to your question, Samadhi. Just quickly, I'll explain this outcome. Okay, right. So, the same pattern. Decision making around 30%, sometimes 28%, sometimes 32%. Risk and uncertainty always around 15 to 14%, 12%, 10%. 1 year it has been 20%. 1 year it has gone down 9%, but slightly here and there it goes. And working capital management, it's around 10% almost all the, except in this July 21 paper. I don't know, there had been some exception, but apart from that, yeah. I will share this analysis, but I don't know how I can share it here. I will share this analysis. I'm sharing it. Okay. So it has the MCQ analysis and past paper analysis. Everything is there. Okay. So just keep it for yourself, but just for your understanding. So I don't want to make a prediction, as I told you, but put your effort in this way. You know what areas you have to put more effort. What areas can score you more marks. What areas you need to, I mean, I won't say less effort, but you can manage, right? So likewise, pay your attention like that. So for any of the areas, and at the same time, you get the topics. You get the topics. I don't want to share this. You get the topics for all these in your study pack. If you move on to the first part of the study, by this time you should have done all these things. But since you all are asking, you see, Part A, modern manufacturing environment, ABC costing, strategic cost management, value creation, environmental costing can come. Learning curve also is part of this, can be tested. Part B, standard costing variance analysis, capacity planning, budgeting, responsibility centers, and transfer pricing. Capacity planning, sometimes it has been tested, not very regularly, right? That is part A and part B. So I'll look at part C, short-term decision making, marginal costing, discontinuation decisions, make or buy decisions, those aspects. Long-term decision making, it's about project evaluation mainly, pricing, and big data for this thing. Transfer pricing goes for part B, I'm sorry. Part C, you get the pricing. Risk and uncertain decision making is partly, that is risk management, the TARA framework, and decision trees, payoff tables, probability decision making, and working capital management, inventory management, debtors management, cash management. Sometimes creditor management, not regularly. Okay, right. So let me get back to the paper. And I'll move on to the answer sheet. Right. So let me share the answer screen. Okay. So I hope y'all, okay, somebody was asking a question. Let me explain that also. Uh, yeah, only show the wholesale. In this, we have to only show the wholesale provide the flour on 200. Yeah, yeah, yeah. Here, like you can have that. I forgot to draw that here. Outside market can provide it at 200. Outside supplier, right? Price equals 200. You can buy from that. So that's the suboptimal decision we are making. Okay, we'll quickly move on to the next one. I'll share the paper again. So it says discuss. Now you'll have to explain a little bit. Keyword is discuss here. But if you want, you can support a calculation also. But mainly you'll have to say, okay, this has to be something more than the variable cost, but something less than the outside market price. Something more than 120, but something less than 200. Question number 3. EFG Limited manufactures punching bags of a standard size. Punching bags are the ones in these martial arts and all, karate, boxing and all they are using of a standard size used for martial arts. Projected number of 2025 are given below for 2025. Sales revenue 9,000 bags at 10,000 each. Okay, 90,000. Manufacturing cost is given direct material, direct labor, variable overheads, fixed overheads. Total cost, admin overheads, selling and distribution overheads, right? Admin overheads, selling and distribution overheads, like the delivery cost, advertising expenses, profit is given to the 800. Managing director of EFG Limited went through the above numbers and expressed his displeasure about the performance. He provided target that in 2026, a profit of at least rupees 7 million should be generated. Profit of at least rupees 7 million should be generated to achieve an acceptable return on investment. The following strategies were discussed, and the management accountant is supposed to analyze them. Strategy A, market research has indicated that a 10% reduction in the selling price would increase the demand by 5,000 additional units. Strategy B, if an additional 2 million is invested in advertising, the quantity of demand can be increased by further 20%. If an additional 2 million is invested, the quantity of demand can be increased by further 20%. Here, 10% reduction in selling price, increase the demand by 5,000 additional. If this is done together with strategy A, the selling price would be reduced, would be the reduced price, where without the strategy A, it would be the original price. If you are doing the strategy A and B together, selling price will be the reduced by 10% reduction in strategy A. If not, it will be the original price. Strategy C, inquiries have been made for an export order of 4,000 bags annually, where the inquiry is expecting a very competitive price. Okay, inquiry is expecting a very competitive price. All export and delivery costs, including freight, will be borne by the customer. Export order of 4,000 bags annually, where you are expecting a very competitive price. All export and delivery costs, including freight, will be borne by the customer. You don't have those expenses. No sales commission will be paid. That is very important. Company will have to incur a special packaging cost of 300 per bag. That is strategy C. Assess the incremental profits generated by implementing strategies A and B. Discuss the different combinations of strategies by which EFG Limited could achieve its profit target of rupees 7 million in 2026, indicating the pricing of export order referred to in strategy C. Okay, right? So to save time, I'll share the answers. Hope y'all can see the screen. Okay, right? Let me increase this a little bit so that everyone can see it. This is the present situation. I have got the revenue minus the cost. Same thing what is given by the examiner. You don't have to write that even, but I took it for easiness in the answer sheet. Strategy A, 10% reduction in selling price increases the annual demand by 5,000 units. That's what it says. 10% reduction would increase the demand quantity by 5,000 units. Okay. Right. So what will happen? 9,000 bags become 14,000. 10,000 rupees become 9,000. New selling price here given. New selling price 10,000 to 90%. 10% reduction to 9,000 per bag. New quantity of demand 9,000 plus 5,000. Additional 5,000 we are selling. Okay. 14,000 and 9,000 each. So 126. The early it was 90,000. Now it has gone up to 126,000. And manufacture direct material, you'll have to, now you are doing it for 14,000 bags. No? Early it was 9,000 bags, now for 14,000. Divide by 9, multiplied by 14. Okay. Divide by 9, multiplied by 14. Like direct labor, variable OH. What they are saying is, if strategy A yeah yeah, if you are going for strategy A, there is a 10% reduction in selling price and increase the demand by 5,000. And along with that, they're also telling managing director was not happy, and in 2026, at least 7 million should be targeted to achieve an acceptable ROI. Okay. Now, in that aspect, what we are doing here is they are talking about a sales commission, right? They're talking about a sales commission 3% and delivery cost 500 per bag. Okay. I have considered yeah. So to get the contribution, I have considered the variable cost. Sales commission is also variable cost, 3% on the revenue, 3% on the new revenue, 126,000. Delivery cost 500 per bag, 500 into, this is 500 into 14,000 bags. 14,000 bags. Okay. 14,000 bags, 7,000. So you get 94,780. That is the total variable cost. Total contribution will be the sales revenue minus total variable cost. You get 31,220. Fixed overheads, no change. Early it was 12,000. Now also it's 12,000. And admin overheads is a fixed cost. Advertising expense also assumed to be a fixed cost at this point, right? They don't mention anything about it. So when you deduct them, you get profit 5,225.22 million. Earlier it was 2.8 million. Now it is 5.22 million. If you go for strategy A, incremental contribution is 2,420,000. Strategy B, additional 2 million investment invested in advertising, demand increases by 20%. Now, there are two options. Okay. Right. So first one we'll assume this is without A. Without strategy A happening parallel. Yeah. I have not mentioned it here. Without strategy A happening parallel. When it is happening parallelly also, we'll see. Now here what will happen? Additional 2 million investment advertising. Advertising expenses go up. All others like increases by 20%. Earlier it was 9,000. Earlier it was 9,000 new demand. Earlier it was 9,000. Now it has increased by 20%. It is increased by 20%. It goes up to 10,800, the new demand. 10,800 is the new demand. Okay. What's the price that we are applying? 10,000 rupees each. No, currently 10,000 rupees each. So 10,800 multiplied by 10,800 multiplied by 10,000, right? Actually 10,800 or 10.8 multiplied by 10,000. You get 188,000 in rupees thousands, 108 million. So in your 20% goes up means 27,000. Early it was 27,000. That is for 9,000 bags. Now 20,000, 20% going up to 1,800 bags additional. So this is like 9,000 plus by 20% going up to 1,800. You get 10,800 multiplied by 10,000. That's how you get that. Same way for labor and variable overheads. 9,000 the original sales by 10% reduction. This is sorry, not for this one. This is for this one. 20% demand increases. Okay. The material, labor, variable overheads proportionately you'll have to adjust. Fixed overhead, no change. So you get 76,800. Admin overheads, no change. Sales commission, 3% of the new revenue. Delivery cost 500 per bag. So it's basically here it has to be 500 per bag. No, how many bags? It has to be 500. Sorry, this has to be 500 into 10,800. 10,800. Yes. 10,800. 500 into 10,800. Okay. So these two are changing. These two are changing. 3% of the revenue is changing. 500 per bag into number of bags also changing because 10,800 bags. And advertising expenses per annum is 8,000. Because earlier they say 2 million additional, early it was 6 million. Early advertising cost was 6 million, now 2 million additional they have added. This is also changing. Profit is 6,560. Okay. And yeah, so that's it. That's it, 6,560. So it's gone up. Earlier 2,800 to compare that, it's gone up. Total contribution 34 million, 34,560. Yeah, so here I haven't mentioned the contribution, right? So you get 108,000 minus variable cost minus these two. Incremental contribution is there, incremental fixed cost is also there. Anyway, profit goes up compared to 2,800,000. It goes up by 6,560 minus 2.8 million, 3,760 million. Okay, it goes up by 3,760 million. This is strategy B alone. Strategy B alone. Strategy A alone increases the contribution by 2.4 million, while a strategy B increases the profit by 3.76 million. And finally, part B, they are asking if they are done together. Strategies A and B, right? Done together option is also there. No? Incremental contribution from further sale of, so further 20% increases quantity of demand with strategy A. If strategy A is there, 10% reduction of selling price increases annual demand by 5,000 units. Increases annual demand by 5,000 units. That is, they are going up to 14,000. No? But originally they were selling at 10,000. And if you are taking strategy B, demand increases by 20%. Right? 20%. So incremental contribution is like 20% of increase of 20% of sales quantity. But selling price will be at rupees 9,000. Strategy A combined, no, because what they say is if strategy A and B are combined, is in the question the strategy B, the last sentence they are talking about, if this is done together with strategy A, the selling price would be the reduced price, whereas without strategy A, it would be the original price. So selling price will be reduced, but demand can be increased by 20%. So on that aspect, incremental contribution from increase of 20% of sales quantity, right? So currently, like they have a contribution of 90,000 minus these things. Okay, 90,000 minus these variable costs. Okay, I'll explain way of changing A and B, right? Strategy A, 10% reduction in selling price increases the annual demand by 5,000 units. How much is the annual demand now? 9,000 bags at 10,000 each. So 10% deduction, 10,000 price becomes 9,000. New selling price is 10,000, 90%, 9,000. New demand quantity by 5,000, it goes up. 9,000 bags earlier now become 14,000. I know this 9,000 is a bit complicated. I purposely gave that number to confuse some of you, right? 14,000 bags at 9,000, you get the new selling price. All the direct material costs are adjusted for new quantity of 14,000, new demand quantity of 14,000. Early it was 2789, now 2042, 28, 14. Right? Sales commission 3% of the revenue because it was already there. No? But why I have taken up to include that in the variable cost and get the correct contribution. 3% of the revenue, whatever the revenue here, 196,000 into 3%. Delivery cost 500 per bag. Now we are going for 14,000 bags. So 500 into 14,000. So the total variable cost. But still the total, now if you look at this one, this situation, shall I put it like this? Shall I put it like this? Sales commission 3% here. Sales commission 3% here. I'm just, manipulating the thing. Delivery cost of 500 bags. Delivery cost of 500 bags is here. Okay. So you have the right total variable cost. Total variable cost. Total variable cost will be 61,200. So total contribution. Total contribution. Because without knowing the variable cost, you can't talk about a contribution. Is this minus this. 28,000. Sorry, don't take this down. This answer is getting wrong. So fixed overheads, 12,000 will come. Selling and distribution and sales revenue already considered up. Delivery cost 500 per bag is already considered up. Okay. So this is what we had in the question, right? Sorry. $2,800. Now, total contribution 28,800 going up by I-49 minus I-4. Total contribution is here. Already calculated. Okay. Right. So strategy A, what you need to understand is with these changes, your profit will go up. Your contribution goes up. Contribution earlier 28,800. Now it's 31,220. Profit earlier 2,800. Now it's 5,220. Okay. So this minus this. And here profit minus. So same rate. Contribution increase means profit increase. Okay. Strategy B, what we have done is only strategy B, additional 2 million investment. So advertising cost went up. Out of the fixed cost, advertising cost went up. Okay. And here also, like you can get fixed overheads down and other things up. I'll put it like that. Fixed overheads down and other things up. Selling and distribution overheads going up so that you get the contribution. Sales and this thing going up. I kept in the same format given by the examiner, but sometimes it can be confusing to some of you. I'll just get the copy paste here. This is selling and distribution. Selling and distribution, variable cost. Okay. Hold on. I'm just changing the same thing. And fixed overheads comes here. This is disappearing. Advertising expenses went up by these figures are wrong. I'll correct it. Advertising expenses went up by 2 million. So it's 8 million altogether. 8 million altogether. Right. Let me correct it. Sorry. Admin overheads 8 million and advertising expenses 8 million. Right. I'm getting the contribution for easy understanding. So this is the profit. Okay. Fixed overheads, I have put it down. So the total contribution equals this figure. Incremental contribution is 5,760. And incremental profit is 3,760 because fixed cost also went up by 2 million. Advertising expenses went up by 2 million. This is strategy B. Can you understand? Demand increased by 20%. 9,000 into 20%, 1,800. So by it went up to 10,800. 10,800. Right? So 108,000 was the 108 million was the revenue. Proportionately, these three went up. By 20%, direct material, direct labor, and variable overhead, it's gone up compared to the original scenario. Compared to these, proportionately by 20%, these are gone up. Sales commission is anyway 3% of the revenue, 3% of 108 million. Delivery cost 500 per bag, now 10,800 bags, 500 to 10,800, 5,400, 5.4 million. So this is the total variable cost, and this is the contribution, total contribution. Total contribution. Are you clear up to that point? So the profit strategy B alone will increase up to 6.56 million, which is an increment of 3,760 million. Whereas the contribution will go up by 5.76 million without the advertising expenses expenditure increase. 5.76 million incremental contribution. So we are more worried about the profit increment. It's better than strategy A. Strategy A, incremental contribution and incremental profit both 2.42 million. But here it's better than strategy A. What I want to explain is this combination part. Further 20% increase in quantity of demand with strategy A. Why? When you are at strategy A, you are already selling 14,000 bags at 9,000. Additional 5,000 is sold at 9,000 rupees. Yes, strategy is additional 5,000 is sold at 9,000 rupees. So you are selling 14,000 units at the price of 9,000. And on the top of that, we can increase further 20%. So what I am doing is this contribution here, 31,200, this contribution, you don't have to waste time. Sales also go up by another 20%. These costs also go up by another 20%. So the contribution goes up by another 20%. How much is the 20%? By 2,800. New selling price is 9,000 per bag. New additional demand is 2,800. 14,000 to 20%. By 2,800, this goes up out of 14,000. Additional contribution is 6,244,000. Additional advertising cost is 2 million. Yes, somebody has raised the hand. So only you can ask the question or just chat or whatever. This is a shortcut, but I know for some of you it may be confusing. I'm ready to answer. I have done a shortcut here to save the time. But if the shortcut is not understandable, tell me, I will explain in detail. A and B combined. I put it as B1. A already you are selling, you have reduced the price to 9,000 and you are selling 14,000 units. So with this additional 20%, we can sell strategy B that by increasing the advertising cost by 2 million. So they said if you are combining with A, it will be at the reduced price. If you are not combining with A, it will be at the original price. That's why earlier we put 10,000 as the original price. Now 9,000 is the revised price. Are you clear with this or do you need an explanation further? Okay. Are we good to go? Part B talks about discuss the different combinations of strategy of EFG Limited could achieve its profit target of 7 million in 2026. 7 million target is expected by the managing director. No? How can we achieve it? Indicating the pricing of export order referred to in strategy C. Now, strategy C, export order 4,000 bags annually. There's a packing cost going up by 300 rupees per pack, they say, right? Inquiries have been made for an export order of 4,000 bags annually, where the inquiry is expecting a very competitive price. All exports and delivery costs, including freight, will be borne by the customer and no sales commission will be paid. Freight and delivery costs borne by the customer, no sales commission. Special packaging cost 300 per bag. So special packaging cost you get 4,300, 1.2 million, 1,200, 1.2 million. So variable cost per unit you get direct material for 4,000. Now, how do you get those values? How do you get those values? Because they are here, no? Right? So how much is this? 27,000 divided by 9,000 bags. Direct labor 18,000 divided by 9,000 bags. Variable overhead per unit cost. Per unit cost. 9,000 divided by 9,000 bags. Sales commission revenue will not be there. 3% of the revenue will not be there under strategy C. Delivery cost and others will be borne by the customer itself, except for the special packaging cost. So here, my dear students, direct material I have taken 4,000 into 3 rupees per unit, 4,000 into 2 rupees per unit the labor, 4,000 into 1 rupee per unit is the variable overhead. Packing cost of this 1.2 million. So variable cost per unit is 25.2 million for how many bags? 4,000 bags. 25.2 million divided by 4,000 bags. 6.3 million. XYZ needs to make an additional profit of at least 4 point because target is 7 million. Current profit is only 2.8 million. So another 4.2 million at least you need to earn profit. Target profit. $7 million. Okay. So strategy A and B together, if we use, now strategy A will anyway increase our profit by 2.42 million. No? Incremental contribution will be 2.42 million, right? 2.42 million. But strategy B and A together, B will further increase 4.2 million. So when you add up those two, 2.4 million plus 4.6.664, right? We can minimum want to increase 4.2, but strategy B and strategy A together will increase 6.6. Strategy A and strategy C require additional profit is 1. Why? Because here strategy A and strategy C anyway they want to increase by 4.2 million, no? But if we apply strategy A, already 2.42 million are there. So balance you need 1.78 million. And contribution per export bag required 445. Why? Contribution per export bag, because how many bags are there? This is 1.78 million. No, these are in rupees thousands. Don't forget. These are in rupees thousands. Actually, 3,000 places has to be added here. Rupees thousands. Okay. But only thing here, it will be rupees. It will be rupees. Okay. It will be rupees because this 1,1,780,000 is the required profit by including A and C together. A gives you 2.42 million. Another 1.78 million is required by selling 4,000 export bags. So that will give you this 445 contribution per export bag. Okay. Right. And minimum price that they need to incorporate will be 445, by which the contribution goes up, and variable cost is variable cost per unit is 6,300,000. So 6.3 plus 445 will give you 6,705. Minimum, if we sell it at 6,745, we can achieve this, right? Minimum price. They're asking is like different combinations of strategies that could achieve target profit of 7 million. So you'll have to reduce the price to 6.745 million. Early it was 9,000 per each, likewise, right? And finally, strategy B and strategy C together required additional profit is because strategy B alone will get you 3,760,000. Strategy B alone will get you 3,760,000 without strategy A. Another small percentage required, another small amount, 440 million only. This is 440 million. And this is contribution per export bag is rupees, because 440 million divided by 4,000 bags. It's 110. 110. Okay. So the minimum price is variable cost is 6.3 million plus this 110 contribution 6.41 million. So you can adapt to get the target profit. Either strategy A and B should work together, or strategy A and C can be adapted, or strategy B and C can be adapted to get, because we need only 4.2 million, but we are getting more than that. Are y'all okay up to that point? Okay, I can move on to the next question. I know we are going for a few hours, but I feel this is valuable for you to get to know. We can just share the set of answers, not a problem. But some of you will understand, some of you may not understand like what we are explaining. So I'm thankful that all of you are here. Majority of you all are here, right? So just let me know if you need any further clarification. If you want, we can go on to the next question. So these are the three different strategies that we can, strategy combinations that we can use to get the minimum required profit of 4.2 million, right? Additional profit by at least minimum required profit. $4.2. Okay. So that is there. Question number 4. Question number 4. MN Computers Private Limited sells computer hardware items. It imports items directly from foreign manufacturers. You can quickly go through this. I'm sorry, I'm unable to switch on my video. My display due to some reason it's working. I don't know, the Zoom login, something has happened. It's nothing to do with my camera or anything, but I don't know, something is there. So I'll move on like this. So sorry about it. Right, question number 4. MN Computers Private Limited sells computer hardware. It imports items directly from a foreign manufacturer and sells them locally. A new type of print is manufactured by a foreign supplier, and MNC is interested in marketing it locally. It was estimated that MNC could sell an average of 300 units a month consistently. Purchasing price of the new printer would be 10,000 per unit. MNC imports are handled by an outside service provider for which it charges a handling fee of 36,000 per shipment. Service provider has informed that it will take a minimum of 10 days, maximum of 20 days from the order time until shipment is delivered to MNC's warehouse. MNC arranges the supplier's payments from a bank loan obtained at an annual interest rate of 15%. And the warehouse has confirmed that it will require 500 rupees annually to hold one unit. Holding cost consists of annual interest rate 15% and 500 rupees to hold annually in the inventory. After a successful negotiation, the procurement manager was able to secure a price discount of 5% on the price. Discount of 5% on the price of this new product. Why, for which MNC is supposed to place at least 600 units per order. If you are ordering at least 600 units per order, you will get a 5% price discount. Advise whether MNC should accept the discount offered by the supplier to achieve the most economical inventory management cost. Calculate the buffer safety inventory level for MNC. Explain the role of economic order quantity in working capital management. This is a working capital management question on inventory control. So please don't expect inventory control only this time. Please go through cash management, BOMOL model and other stuff. Debtors management, go through those also, because you never know which area. One of these areas for 10 marks definitely will come. 10 to 12 marks maximum definitely will come. So please go through that. So here my question is on what do you call inventory control, inventory management. Okay, let me share the answer to you without wasting time. You'll have to get the economic order quantity. Monthly demand is given as 300. Sorry, annual demand is given. Yeah, monthly demand average 300 per units per month. D stands for annual. This is the EOQ formula, 2DCO upon CH square root. D stands for annual demand. This is annual demand. Annual demand. So monthly demand, you multiply by 12 to get the annual demand. This is by 300 multiplying by 12. Okay. And ordering cost per order, they are mentioning somewhere. Handling fee of 36,000 per shipment. Per order, handling fees 36,000. So handling fees also ordering cost. It is handling fee 36,000 per order. Cost of holding, there are two aspects. One is the annual rate of interest, 15%. So 15% you rate the interest, and the warehouse has confirmed it will incur 500 annual to hold one unit. Per unit holding cost is 500 here. Plus, what is this 10,000? The purchasing price. Right now, we are purchasing at 10,000 on that 5%. On every unit that you buy, you spend money, or you without paying money even, you buy, the cost is there. 10,000 is per unit cost. Out of that 15%, we have to pay an interest, because we are getting that rate of 15%, annual interest rate of 15% from the bank loan obtained to manage your working capital. right? So on that, every unit that you sell, 15% has to be sold. So 500 plus 10,000 into 15%, altogether CH is 2,000. So D is there, CO is there, CH is there, substitute those to the formula. You get the economic order quantity 360. Now what do you have to do? Calculate the purchasing cost, because they say if you buy it at 600 per order, right? This 10,000, the purchasing price will go down by 5%. There's a 5% on the price. After successful negotiation, procurement manager was able to secure a price discount of 5% on the price of this product, for which MNC is supposed to place at least 600 units per order. So we are evaluating the two there. We are evaluating the two, right? EOQ, the basic EOQ is 360. If you go for 360, how much is the purchasing cost? Price into demand. Price is 10,000 into demand is 3,636 million. Total ordering quantity, D over Q stands for number of orders. How many orders you make if you buy 360? 3,600 annual demand. Within 10 orders, you can manage. Order cost per order, 36,000. So your ordering cost will be 360,000. Now you see, this is important. Total ordering cost and total holding cost, average quantity, we assume no buffer stock. Assume no buffer stock in inventory control, especially EOQ model, no buffer stock, no, no safety stock or anything. Theoretically, there's nothing, right? So total holding cost is average quantity. Maximum you'll go up to 360, again come down to 0, right? So no buffer stock or anything. So 360 has to be divided by 2 and multiplied by 2,000. What is that 2,000? The holding cost you get. Okay, right. So the thing is, you can check whether your calculation is correct. The total ordering cost and total holding cost is equal when it comes to basic EOQ. Unless there's a small rounding up error or anything, total ordering cost and total holding cost are equal when it comes to this thing, because I think in many places I have drawn this, but with some of you, I think maybe meeting me for the first time. So let me check. So I will if you look at cost of inventory, quantity, quantity and the cost, right? You have the ordering cost with quantity per order. This is quantity per order, quantity per order. Ordering cost comes like this. Ordering cost like this. When the quantity goes up, it comes down. Right? And ordering cost is coming down here. Right? This is total ordering cost. And total holding cost is like a straight line. It will go up based on this assumption. Q divided by 2 over CH. Total holding cost going up like that. Right? And total inventory cost will be like this. Addition of these two, it will come down. It will come down and then go up. Optimum order quantity and go up. It's not the total quality management. Something like this. Okay. Total inventory cost. My shapes are not very great, but I just want to get you the idea. Total inventory cost. Okay. Right. So here at this point, you get the basic EOQ, what we calculated, the 365. So 360. 360. So you are here. At that point, you see total holding cost and total ordering cost cross each other, which is why they are equal. Which is why actually they are equal. This is how it goes, right? So at the quantity of 360. But if it comes to 600, it will be somewhere here. 600 will be somewhere here. It's not the optimum. Okay. I'll just draw a line. Somewhere here. Right? So they are like you get, okay, when you get the discount 600, it's not 10,000 minus 5%. 10,000 minus 5% will be 500 rupees deducted, 9,500 into the annual demand doesn't vary here. A lot of people make mistakes, my dear students. Price into quantity they put, not the Q. Q is quantity per order. Is the total purchasing cost annual? No, all these costs are annual. Total annual inventory cost we are talking about. Total annual inventory cost. Okay. So here, addition of these three purchasing cost price into demand 36 million plus these two will give you the total annual inventory cost. But here 95% of the price, 5% deduction is there. So you end up with a purchasing cost of 34.2 million. But at that point, your order quantity is 600. So 3,600 demand, you divide by 600 into 36,000. So this has come down. Ordering cost has come down. You see, compared to the basic QQ, ordering cost has come down 216,000. But holding cost going up drastically. Q divided by 2 into CH. So, yeah. So CH is your 500 plus the new price into 15% plus Q divided by 2. Quantity is 600. So you see this one is higher. Ordering, the holding cost is higher. Ordering cost is lower. That is what has happened here. Holding cost is high. Ordering cost is low. But annual inventory cost can be minimized from this option. Okay. Right. So this is for just for your understanding, and MNC should accept the price discount offer, because if you go for the price discount offer, accept the price discount offer because their total inventory cost can be reduced. The total inventory cost can be reduced, or will be reduced, I would say. Overall inventory cost has come down compared to basic EOQ, total annual inventory cost. Okay. There's a part B of that question. I know, like, we are getting a bit late, but we'll quickly finish off this. Calculate the buffers or safety inventory level for MNC. Now, buffer stock you'll have to get, you need to know the reorder level. Reorder level, reorder level is given by maximum daily demand into maximum lead time. Maximum daily demand into maximum lead time. Right? So maximum daily, not the daily demand, monthly demand in this case, the rate of demand, 300. So uh, pre-order level is maximum rate of demand to maximum lead time. Daily demand, or in this case, it is monthly demand. Monthly demand is 300, right? Okay. So, sorry. It's the daily demand. I'm correct. I'm sorry to confuse. Maximum daily demand. So the monthly demand is given 300 per unit. Annual demand is 3,600. Then daily demand, therefore, daily demand equals 300 divided by 30 days, no? 30 days per month. Okay. Right. So reorder level gives you like 300 divided by 30 is 10 per day, no? 10 into how much is the lead time given? 20 days. Lead time is given okay. Right. So here reorder level daily demand is 10 per day into lead time is given in the question. It takes a minimum of 10 days and a maximum of 20 days. So here you put the maximum lead time 20 days. So at level of 200 you need to start reordering. But that is reorder level, no? If you take the average lead time versus into average daily demand is anyway 10. Average lead time would be 10 plus 20 divided by 2. Average lead time, they say minimum lead time is 10. Maximum lead time is 20. So 10 plus 20 divided by 2, the average is 30 divided by 2, 50. That's how you got here. Okay. That's how we got here. 15 into daily demand 10. So that is 150. So the buffer stock will be reorder level minus average T into average LD. Please remember this formula. Buffer or safety inventory stock is what is asked in the question, right? It's reorder level minus average daily demand into average lead time. What is reorder level? Maximum daily demand into maximum lead time. When there are fluctuating daily demands and fluctuating lead times. So buffer stock is like maximum you get 200, no? Otherwise, it's average 150. So 200 minus 150, 50 units for the buffer inventory level. Are you okay up to that point? Part C, they are asking explain the role of economic order quantity in working capital. I'm giving the point form answer, but you can explain those a little bit. First point is EOQ determines the optimum order size of products, which minimizes the company's total inventory cost. So it helps companies to manage their inventory efficiently. So you can discuss a bit more if you want on that. In the absence of an optimum inventory level, companies may hold too much of inventory during the low annual demand. Okay, this leads to cash being invested in excess inventories. If you don't know the optimum inventory level, if you don't know the real reorder level, right? If you don't know what is your EOQ, you just keep on buying or manufacturing, holding too much of inventory when the annual demand is lower. So cash excess being invested in inventory can happen. Further, if the company holds too little inventory during the high annual demand period, it will lose certain revenue due to stockouts. So EOQ model assumes there is no stockout situation and there is no buffer stock cost, but practically you can get those. Leads to cash being invested in excess inventory, and further, the company holds too little inventory during high annual demand periods. Yes, somebody's raising hand. You can ask. You can either type or you want to speak and ask the question. You can ask the question or you can type. Nitya Raj, I think. Okay. Right, I don't know. I didn't get the question. Have you typed the question? Right. Company holds too little inventory during high annual demand period. So buffer stocks are required, and that is again coming under optimum inventory management. Role of economic order continue. Then you have enough stocks until the next rollout or next cycle. Hence, the EOQ helps to efficiently manage inventory ordering and supports optimum working capital management. Right? So that is talking about the role of economic order quantity in working capital management. Okay, we'll move on to the next question in the interest of time. Question number 5. I'm sharing the mock paper again. Okay. Innovators Private Limited is planning to develop a new laptop and will have a lifetime of 3 years. The development process will take 1 year. This is life cycle costing. It says commencing at the beginning of the second year. IPL applies life cycle costing for its products and estimates made for this New laptops are given below. Sales units in terms of production, 3,000, 10,000, 2,000. Overall life cycle cost, 15,000. Year one, no production. Product development happening in year one. Marketing cost in year one. Year two, you get variable production cost, fixed production cost, and marketing costs. So loss from the product laptop, there's a loss. The above estimate was prepared by a trainee management accountant who has not considered the learning effect of his computation. 30% of the variable production cost in year two is estimated to be labor cost. Year two variable production cost here, right? 15% wage. Year two, the 30% of the variable cost in year two is the estimated labor cost. A 15% wage increase has been considered for the computation for year three, which would remain at that level. 15% wage increase has been considered for the computation from year three. You are the senior financial control of IPL, okay, Innovators Private Limited. Based on the above information and discussions and with the production team, now we have realized that although the first unit is expected to take 3 hours, a learning curve of 80% is expected to occur until 200 units. A senior financial control of IPL, you are required to present a re-evaluated proposal uh, requested to present a re-evaluated proposal to the management. Incorporate effect of the learning curve. The value of learning coefficient at the learning effect is y equals ax plus b, ax to the power b, learning effect, the learning curve formula of 8%, the b value is minus 0.3219. The examiner sometimes give it. In that case, you are lucky. If not, log 0.8, log 80% divided by log 2 is what you need to do. I'll explain that. Explain the management of IPL, the learning curve effect and its impact on the production cost theory aspect. Assess the revised life cycle profit, considering the effect of learning curve. Part B is the calculation. So I will take you all through the answer. Okay, someone is asking full answer for Q3. Right. Okay, I'll go back to the answer. Question number 3 we have on. What I'll do is I'll share this with you all. So that will be easier. But any changes happening here at the end of the session, I'll share it. Okay. Like this. Give me a second. I'm sharing the answers so far. If there is any further update to my answer, I'll share it by the end of this session. Okay, so you have that, right? So if any one of you miss, because I don't want to waste everybody's time, but I value that you have a concern if you miss some area. That you can cover with the answer sheet that I'm sharing in the chat. Hope you'll be able to download it. If not, I'll get it circulated via the Chartered Institute, right? Now here, what's the importance? First part is on explain the management of IPL, the learning curve effect and its impact on the production cost. Okay, so what do you have there? If there is a manual task performed by an employee or employees which is repetitive, the time he or she takes, to complete the task in subsequent times gradually reduces with the learning and experience gain. If you want, I haven't drawn here. If you want, you can show that. Okay. If you want, you can give a graphical effect also along with the time. Right? Time versus cost. Time versus cost or time taken to produce additional unit will gradually reduce. So this I say quantity versus time. Time taken per unit. So it will come like this. It will come like beyond a particular point, you can't. Like there's anyway a time taken to produce, no, right? But up to that point, there's a curve. So this is a learning effect. So at 80% learning effect, uh, at 80% learning effect, what you call, you will be able to calculate it. Now it's given here, no? Right? How do you get that? B is equal to log 0.8. What is 0.8? 80%. Log 80% divided by log 2. If you have your scientific calculators with the logarithm function, you can check it. If not, log 0.8 divided by log 2. Why by 2? Because it's like, it's talking about the time taken to produce additional unit. The first it takes, let's say, 4 hours. For 2, it will be like 2 hours, like it's reducing, right? Gradually reducing. When you double the product, when you double the production, with the learning, you reduce the time taken by half, something like that. Not half, whatever the percentage. So this will give you this minus 0.32193. Actually, the examiner has given, in the paper I have given only 3219. So you can use that without any problem. Okay. Right. So what will happen here? Sales production, the sales won't change. Product development cost, variable production cost. This is the given data. Given data in the paper. Loss from the product laptop is 4,250,000. Okay. So what happens during the year 2, year 3, and year 4? You get the variable cost, 15 million. Out of that, 30%, no? 30% is not 25%. 30% is variable cost. 30% is variable cost, so 4.5 million. Production quantity in the year 2 is 3000. Labor cost per unit you get 1500. Labor hour consumption for the first unit is 300. So labor cost per hour is 500. So this is what they have done. Okay. Year 3 production quantity is 10,000. Labor hour cost, I think somebody said this is going up by a 15% wage increase, no? 15% wage increase. So 1,500 multiplied by 115%. 1,500 multiplied by 115%. You end up with 1,725. That's how we get this figure. Okay. Right? Year 4 also it will remain at the same level. So the production quantity is there. This is there. So this computation is wrong. Labor cost per, I mean not wrong entirely, but initially the learning effect is not considered. So computation of correct labor cost for the first 200 units, only up to the first 200 units occur. The learning curve of 80% will occur only until 200 units. So this is that 200. This is that 200. At 200 units. Okay. So until such time, learning curve has to be applied. Learning curve has to be applied. So y equals ax to the power b. You apply x is 200 for the first 200 units. A is 3. A is the time taken to manufacture first unit. A is the time taken to manufacture, because we are having a learning curve. First unit, that is 3 hours. Okay, 3 hours. So x equals 200, y equals a equals 3, and b value is there. You substitute the formula 0.545 per unit. Y value, what is the y value? Right, the time taken, average time taken. This is, I'll put average time taken. Average time taken. So average time taken to okay, right? So total labor, I mean, you get 0.54 by applying this formula, my dear students. A is there, B is there, X is there. You get 0.5445 per unit. That you multiply by 200. That you multiply by 200, you get the hours. 0.545 multiplied by 200, 109 hours. For the first 109, because what they ask is the learning curve impact. No, the learning curve will not be having any impact beyond this. So first 199 units, same formula you apply, changing the x value to 199. Then you end up with 0.546 per unit, but that you get hours, okay, hours, that you get 0.546 multiplied by multiplied by 199. See how much? Okay, right. So then what has happened here is time taken for the 200 unit you get. This 108 is taken for 108.6 is taken for first 199 units. 109.006 is for first 200 units. So the difference will give you the time taken for 200 units, 0.370. This is hours. And no learning curve effect will improve thereafter. Okay, right? To up to 200, the learning curve effect is there. Beyond that, it won't improve. So what will happen? Production count is 3,000. Labor hours taken for the first 200 units is this 109.01 or 0.06 or whatever, right? Right? Right. So then advise the life cycle profit considering the learning curve effect. No? So we are taking into the life cycle profit. Labor hours labor are taken for the first 200 units, 109. Thereafter 2,800 to 0.37. Okay. Right. So with that basically uh, thereafter this won't improve. No? The time taken to 200 unit will continue for rest of the units. Time taken for 200 unit, which is 0.370 hours, will continue for rest of the production. So this was the problem earlier where the trainee management accountant hasn't done that and used a flat level here, which is not the correct thing to do. Okay. So rest of the now first year, year two, year one is development. No? Year two, there are 3,000. Out of that first 200, we have considered separately. Balance 2,800, you get this much. Year three, 10,000 into 0.370. Entire thing, no learning effect. It's the 200 unit time. Year four, 2,000 into 0.370, 740. So total hours you get like this. Labor cost per hour, correct labor cost for the year. You can check. Right? So we get it like that. The labor cost per here is like 500, 575. So that is the labor cost per unit. Labor hour consumption for the first unit, likewise per consumption. With that, the learning curve effect we are taking, but labor cost per hour is valuable here. Okay. So you multiply and from the labor cost you increase so that the correct labor cost for the year. right? So the total life cycle cost we are getting from about table 135,250 in terms of, yeah, that is rupees, I guess. Yeah, or rupees thousands. Everything is rupees thousands. 135.2 million. Remove the indirect incorrect labor costs. These incorrect labor costs are being removed. Right? So you remove that unwanted labor cost here, right? So we assume these costs can be removed 1,500 to 3,000, 1,025 to 10,000, 1,725 to 10,000. Okay. So you remove that correct labor cost, you get these costs. These costs you copy down here. Revised correct life cycle cost and sales you can go up to, let's say you sell at 1,000 rupees. So life cycle profit is available. Yes, one hand is raised. You can post your question. Okay, we'll move on to question number 6. Happy to take you all through the question and the answer. KLM Limited is a large-scale construction company with a reputation of delivering quality output. With the recommencement of Kadawatha Kandy Highway construction, KLM has considered taking up two segments of each highway project. The government has opened two segments of the highway construction for tender, namely P and Q, which KLM is interested in. Opportunity to quote for Project Q will be available only after appointing a contractor for the Project P based on the information received. So that means appointing, the opportunity to quote for Project Q will be available only after appointing a contractor for the Project P. Based on the information received, KLM is aware that if it could win the Project P, there is a better chance of winning Project Q as well. The engineers, along with the finance team of KLM, now this is a 20-mark question, my students. You'll have to read very carefully, take some time, 2-3 minutes, and read very carefully. Engineers, along with the finance team of KLM, have made the initial estimates for P with normal price, along according to which the suggested contract value is 5,000 million worth a net profit margin of 20%. Suggested contract value is 5,000 million. With a net profit margin of 20%. Margin, if selling price is 100, margin means 20. Cost becomes 80. Based on the information available, the estimated value of Project Q is 8,000 million. Estimated value of Project Q is 8,000 million. If KLM can win P is Project P, then with the experience of that project, it can earn a net profit margin of 25% on Q. Otherwise, it will be only 15%. If you win P, if you are going for Q, you will earn a profit margin of 25%, but otherwise it will be only 15%. If KLM quotes the normal price of 5,000 million for project P, the chance of winning the project is 50%. Whereas the quoted price is reduced by 10%. If the normal price of 5,000 million for project P, chance of winning project comes down to 50%. And where the quoted price is reduced by 10%. The chance of winning the profit project increases up to 75%. So if you quote normal price, chance of winning project P is 50%. If quoted price is reduced by 10%, chance of winning is up to 75%. Increases up to 75%. In the event KLM quotes the lower price, it will follow extreme cost saving methods to reduce the cost of the project by 300 million. If you go for a lower price, you will save your cost also by 300 million by extra precautions taken. If KLM wins project P, it will not consider any price reduction when bidding for project Q. The probability of KLM winning project Qs in that event is 90%. If KLM wins project P, it will not consider any price reduction when bidding for project Q. The probability of KLM winning project Q in that event is 90% if you win P. However, if KLM fails to win project P, it has an option to consider price reduction for 10% for project Q, enhancing its chances of winning the project bar to 70%. Which otherwise would have been 45%. Otherwise, it would have been 45%. In the case of project Q, there is no possibility of any cost saving. No possibility of cost saving. I know it's a very complicated one with the words. Now, this is the kind of question that you can get, right? Like, don't be afraid that the language kind of like is sometimes a barrier, but we need to overcome this barrier. That's why I gave you a question like this. Draw a decision tree clearly showing the options available for KLM, indicating decisions to be made, outcomes, and related probabilities. Recommend the best course of action for KLM in quoting projects P and Q. Hint, evaluate the decision tree based on the expected value using backward evaluation method. The hint is also given. You need to evaluate the decision. So 17 marks are given for the decision tree and its evaluation. Since decision tree comes under section D with 15%, I have made it for 17 marks. So another 3 marks. Assume there is another project called project R in hand where the initial investment would be 5,000 million. A net cash inflow of 1,000 million is expected every year for a period of 10 years. Annuity. Calculate the NPV of the project. So that's coming under NPV. We'll come to that later. I'll share the answer. Don't worry. Like I have already shared the answer sheet, but Institute will also share it. Okay. This is what we do. Everything in the diagram in black color is relevant for part A, blue color for part B, because evaluation also I have to write there itself. Blue color, whatever the thing available in blue color, if you all can see, those are relevant for part B. Rest is relevant for part A. Drawing the diagram. Now, what has happened here, my dear students? The first decision that you need to make is whether quote for P at the normal price of 5,000 million or whether to go for the reduced price. Reduced price is 4,000 for 10% reduced. 4 million. If you go for the normal price, you get an event. Decision 1 is whether to quote for the normal price for project P or whether to go for the reduced price. If you go for the normal price, chance of winning project P is 50% and losing is 50%. So winning 50%, losing is 50%. And if you win, winning project Q, the chance is 90%, losing project Q 10%. If you lose, you don't get anything. But if you win, you end up with a 25% margin. Here, net profit is 5,000, 20% margin, 1,000 million. And winning project Q, you get a 90% chance. You don't want to go for reduced price. 2,000 will be the winning project. Cost of the project Q will be 8,000 minus 2,000, 6,000, because this is margin, my dear students. Profit margin means, profit margin, if I just explain, cost is there, cost per unit is there, margin is there, I will say just profit per unit, and selling price per unit is there. Selling price per unit is there. If they say 20% margin, which means selling price per unit is 100. Selling price per unit is 100. Profit is 20% of 100. Cost will be 80. Okay. But if somebody says 20% markup, understand the difference between these two. These words, here the word given is margin. Cost per unit is 100. Profit is 20% from the cost. And selling price will be 120. So understand the difference here. So we are talking about the 20% margin. Therefore, that is why net profit 5,000 into 20%. And if you win project Q, there's a 90% chance, and the profit, since you have one project P, that experience will help you get a margin of 25%, it says. But if you lose P, then you have to make another decision whether to quote Q at the normal price or reduced price. You have an option to go for reduced price. Normal price, if you go, that is 8,000 million again. Chance of winning Q is 45%. Losing Q is 55%. If you lose, you don't get a profit. If you win, you get a 15% margin. Only a 15% margin. Right? But if you go for a reduced quoted price, that is 10% reduction of price is possible, it says. However, if KLM fails to win the project B, it has an option to consider a price reduction of 10% of project for project Q. So 8,000 million can be brought down to by 800, that is 7,200 million. And then the chance of winning project Q is 70%, losing is 30%. So what is this? 400 million. Now, if winning project 7, otherwise it's 45%. But they say there is no way of saving further cost of project Q except if we don't win P, yeah. So the cost won't change. Here the cost is 6,000. And if we don't win P, we have a margin of 15% only. The cost will be 6,800. That won't change. So here quoted price is 7,200 and you have no way of reducing the cost of Q. It will remain at the 6,000. Here I have calculated this, my dear students. Earlier one, 8,000 into 15%, you get a net profit of 1,200. 8,000 is the quoted price. 1,200 is the 15% margin. So your cost will be actually 8,000 minus 1,200 equals 6,800. You can go for this lower cost, higher profit. Only if you win project P, you gain that experience and do. Otherwise, if you don't win project P, you're learning from the beginning. So your cost will be 6,800. So this side, you haven't won project P. So they can't reduce the cost further. Only 400 million will be the net profit if you go for the reduced price. And if you lose the project, anyway, you don't get anything. Now, this part has to be repeated for this quoted price at reduced price also. Only thing that changes here, early it was 50% of winning P, now 75% of winning P, and net profit, the reduced price is 4,500. 3,700 will be the cost. How do you get that 3,700? That is 20%, right? So let me check. If you don't, if you go for the reduced price, the profit margin, engineers along with the finance team, third paragraph of KLM have made initial estimates for P with normal prices according to the suggested contract value 5,000 million with a net profit margin of 20%. Based on the information available, the estimated value of project Q is 8,000 million. If KLM can win P, the experience of that project, it can earn a net profit margin of 25% on Q. Otherwise, it will be only 15%. If fourth paragraph, if KLM quotes normal price for 5,000 million of project P, chance of winning is 50%. Whereas the quoted price is reduced by 10%, chance of winning is 75%. In the event KLM quotes lower its the lower price, it will follow extreme cost saving methods to reduce the total cost of project by 300 million. Okay, this is where the key point. Earlier, the cost of the project is 4,000 million. How is that? Net profit margin is 1,000 million. 5,000 is the quoted price. Cost of the project is 4,000 million. They will take extreme measures to reduce new cost of project. New cost of project B. They will take extreme measures to reduce this 4,000 million by 300 million. There's a cost saving. So you end up with a cost of 3,700 million. Can you understand? These are tricky parts of this question. Okay? Tricky parts of this question. Right? So here, that is how you get that 3,700 million, because it doesn't come in the question. You don't see a direct percentage there. You are quoting a lower price of 4,500 million for project B. You win it and you can reduce the cost down to 3,700. You get a net profit of 800 million. 75% of chance of winning P. If you lose, you don't get anything. You don't get it. Forget about the blue colored letters for the time being. Focus on the black colored part. And profit will be needed. Again, the decision is whether to quote at normal price or reduced price. This is a repetition of this event 3 and event 4. 7 and 8 is a repetition of event 3 and event 4. Event 6 is a repetition of event 2. Right? So you'll have to copy paste it or redraw the same thing. 6, 7, 8, copy paste of 2, 3, 4. Okay, when you get the answer sheet, you will understand. So that is the drawing part. Calculations need to be done along with the decision tree marked in blue color. Right? So you come back. Start from the backward calculation. Net profit 8,000, 25%, 2,000. Chance of winning 2,000 is 90%. Chance of losing is 10%. You get 0. Even actually speaking, we need to write the expected value inside the event, but I wrote it outside in blue color so that it's clear when you go through the answer. Otherwise, it will be a jumble, right? So you can write it inside or outside, but this blue color one is relevant for part B. Now I'm coming back. 2,000 into 90%, 1,800 million. Plus here you get a profit of 1,000. That 1,800 plus this 1,000, 2,800. Chance of winning, that is 50%. Only 1,400, 2,850. Chance of winning, that is 1,004. But if you lose, you come this way. You come this way. 8,000 into 15%, 1,200. Chance of winning, that is 45% only. 1,200 into 45%, 540. So here 540. But from this one, 400 million is the net profit into 70% probability. Losing the project, you don't get anything. 400 into 70%, you get 280 million. So you compare, this is a decision, my dear students. If you go for the normal price of Q, you end up with an expected value of 540. If you go with the reduced price for Q, you end up with a expected value of 280. Which one is better? Event 3 is better. This option is better. Quote at the normal price, 8,000 million. That's the decision you are making here. Quote at the normal price. So series of decisions, I'll come to that. And you take it up, 540 coming here, 25% probability. 1,400 from this side. So you take that up. Same case here. Similar calculation here, 540. This part is a repetition. 270 million, 1,400. 1,400, the probability is 50%. 270, the probability is 50%. You do the backward calculation. 540 is the expected value. Chance of winning, that is 50%. Chance of getting that is 50%. Chance of getting 1,800 plus 1,000 is 50%. So you end up with 1,400 plus 270, 1,670 million here. But here you get up to this point same as this part, but here the percentage is 25%. So 540 into 25%, 135%. Again, 1,800 here from winning the project Q. Same as event 2, you get 1200, sorry, 2000 into 90%, 1800. Losing, you don't get anything, no. But here it's only 800, not 1000. Earlier you had 1000 here, but 800 because the cost is 3700 and you have quoted a reduced price. So you get 1950. 1950 to 75%, 540 to 25%, 135. So effective expected value 1915 to 1950 plus 135, 2085. So top you get 1680. Here 2085, 2085 is better. Quote project P at the reduced price. A series of decision. Quote the project P at the reduced price. You get a better expected value. In the event, if you lose P, if you don't get P, quote the project Q at normal price. Everywhere I suggest, if you don't win P, quote the normal price for project Q. The series of decisions, quote for project P at the reduced price. In the event KLM not winning project P, quote for project Q at normal price. If you win project P, nothing to quote, you'll have to just go with the normal price. And the part C, like initial investment is given 5 million. 1 to 10 years, you have an annuity of 1000, 1 million. Get the discounting factor, the cumulative discounting factor, annuity factor, or the present value factor annuity. Discounting factor is 1 upon 1 plus r to the power n. Annuity factor is 1 minus discounting factor, 1 minus 1 upon 1 plus r to the power n divided by r. By this time, you should know this formula. Sometimes the examiner gives you discounting factor, sometimes he doesn't. So you need to know how to calculate the discounting factor. And if it is an annuity factor, how to calculate. If you don't know how to put the annuity factor, for 10 years, you get the discounting factors and get the total, right? But this is the formula for you to get the annuity factor. Please remember that. 5.6502 is what you are getting here. That is taken here. So you get the discounted cash flow. Net present value is 650 million. That is just to test your knowledge on the annuity factors and the discounted cash flows only. That part was given. But main part is this decision tree. I know it's not easy. Please go through this answer very carefully and see if you had done a mistake, where did you do the mistake? It may be with understanding the language, because language itself is a bit tricky, but I wanted to give it like that because that's how you get questions at the exam. Because there had been concerns by students, sometimes these mock exams, the level of difficulty is not so high as the real exam. So I wanted to make sure that it is equally difficult like the real exam so that you get a better experience. But on certain places, I have made it a bit easy, but most of the areas, it's very much same as or in par, or maybe sometimes even a bit more difficult than the exam. So that you get the proper experience. We'll move on to the final question. I know it's past midnight. I'm happy that at least a lot of you are still there, right? Because I also can't assure whether you are getting the recording of this or not, but I'll share the answers definitely. Answers you will get. Recording, it's up to CS Sri Lanka team. I'll check. I can check that, but I don't know whether it's assured, right? Furniture manufacturing company produces three main types. I'm sorry about this type setting. Sometimes has gone with abnormal, right? So this type setting, something has happened. Following information is relevant for three products X, Y, Z. Selling price is given. Variable cost per unit, material, labor, overhead, fixed cost per unit, specific, general, advertising. Total cost per unit is there. General fixed overheads are absorbed based on labor cost. General fixed overheads are absorbed based on labor cost, while advertising cost is a common fixed cost for all three products and is absorbed to each product based on sales. Common part I'll erase. Right? Absorbed to each product based on sales. Monthly budgeted production or sales volume for each product is given to X, Y, Z. The volume is. It is assumed that current sales mix will continue in the future based on the prevailing advertising agenda. You are the senior accountant of XYZ and are given above information, right? Okay, you are the senior accountant of XYZ Limited, the above information are given. Compute the following related to three types of furniture based on the prevailing sales, right? What? Break-even sales quantity and value for each product. This is multi-product break-even, CVP analysis for multiple products and expected monthly profit. Not tested in every paper, but a tricky area if they test. Focus on maybe a bit of this area or the capacity planning because it's not tested in every paper, but there's a chance. Always examiner can make the question tricky. Right. And that is 10 marks. A proposal is under evaluation to increase the advertising cost by 10%, which will change the monthly sales mix in the following manner, with no change to the product specific and general fixed overheads. Okay. Monthly sales mix, increase the advertising cost by 10%, which will change the monthly sales mix, but no change in the product specific and general fixed overheads. Okay. So now early it was 12,000, 36,000, 24,000 with the advertising 10%, 36,000, 12,000, 30,000. Finance manager of XYZ Limited has already given his consent to proceed with this proposal. Part B, assess the revised break-even sales in units and value. Use necessary computations to validate whether the finance manager's action for this proposal was correct. Since the quantity of product Y has been reduced in the revised sales mix, the management of XYZ Limited is considering discontinuation of the production of this product. Advise the management based on the financial and other aspects of the discontinuation decision. So 3 parts. CVP analysis for multiple products and revised CVP analysis and discontinuation decision. In the interest of time, I'll share the answer. Okay. Product XYZ, this is the current scenario. I just used it to get the profit per unit. Yeah. Just to get the profit per unit. Now, the product or sales quantity, the mixed ratio, and the sales mixed ratio 12,000, 36,000, 24,000. That is given in the question. Sales mix ratio is for every 1 unit of X, 3 units of Y, and 2 units of Z. Because 12,000 to 36,000, 24,000, the ratio if you get for every 1 unit of X, 3 units of Y, and 2 units of Z. It's like a sales mix, a packet, right? Sales mix packet, kind of. Now, in that case, the selling price is there. You have the variable cost. I'll put the variable cost here, right? You get the variable cost. This is the answer. And you get the contribution. Only deduct the variable cost from the sales price, okay? And you end up with the contribution per unit, right? I stop there and I get this ratio, sales mix ratio, 1:3:2. Every one packet contains one unit of X, 3 units of Y, 2 units of Z. This is that sales mix ratio concept. So contribution per mix 220 you can earn by 1. You get 220 multiplied by 1. 160 is earned by 1 unit and you sell 3. 480 you get. 190 is earned by 1 unit of Z. You sell 2. 380. So the contribution per mix is 1080. It's like a packet containing 1 unit of X, 3 units of Y, and 2 units of Z will generate a contribution of 1080 for you. Okay. Right. So then we need to get the break even. We are in part A. Part A, break even sales quantity and value for each product. Expected monthly profit. Expected monthly profit. Okay. Expected monthly profit. Right. Now, production or sales quantity, the total I get 12,000, 36,000. This is the budget, budgeted sales and the production. fixed overheads cost per units are given here. These fixed overhead cost per unit that you take. Okay. Total fixed overhead cost per unit 130, 90, 150. Addition of these three. It's already given by the examiner, or in this case myself. You'll have to just add them. Right? Total fixed overheads will be 130 to 12,000. This is like per unit cost, no? 130 into now this multiplied by 12,000. Okay. And 36,000 multiplied by 90. You get 3.24 million. 115 multiplied by 24,000. Once you get the answer sheet, you will see it's the multiplication. So total fixed overhead 7.56 million. Remember, break-even quantity is given by total fixed overheads or fixed cost divided by contribution per unit. This is for a single product. In the event of a single product. Now you have multiple products, no? Multiple products, you can't talk about cost contribution per unit, but you have a contribution per mix. Mix is like 1 unit, 1 packet. How many packets, how many mixes are you going to sell? That's how we can talk about the break-even quantity here. So 7.5 million, you get the fixed overhead, 7.56 million. You divide this by the contribution per unit. 7.56 million divided by 1080. We end up with 7,000 mixers. My dear students, we end up with 7,000 mixers. That is the break-even to break-even. 7,000 packets or 7,000 mixers have to be sold. Each mix carries 1 unit of X, 3 units of Y, and 2 units of Z. Okay. Right. So see 1, 3, 2 in each mix. Break-even sales quantity you get 7,000 multiplied by, this is multiplication by 7,000. 7,000 mixes multiplied by 1. 7,000 packets of X. 7,000 to 3, 21,000 packets of Y. 7,000 to 14,000 packets of Z. And the selling price per unit, they are asking the value. Value always comes in. This is quantity. This break-even sales quantity. Break-even sales value means always the revenue. Revenue, huh? Revenue. So you multiply by the selling price, you end up with the revenue. Are you okay up to that point? I've shared the answer sheet also. I hope you are able to download. If not, Chartered Institute promised actually they'll be sharing the answer sheet. So you can go through it again and just see. But if you have any clarification right now, please ask. I know it's past midnight also. I'm so happy that you all are still committed to stay, right? That commitment is required for you to pass the exam. So I'm so happy, right? So you keep that effort for next couple of weeks, you'll definitely pass the exam. Expected monthly profit. Okay, now we are moving up to part A. Has two parts. One is the break-even quantity and the sales. Expected monthly profit. Okay. Production or sales quantity 12,000, 36,000, 24,000. The quantity is there. You know the contribution. No? Contribution per unit we calculate 220 to 160, 190. 220, 160, 190. Get the total contribution. Right? Multiply 12,000 by 220, 36,000 by 160, 24,000 by 190. Right? So you can do that calculator method. I don't worry about the answer now, but just get to know the method. Okay, multiply and you get the total 12.96 million total contribution. Total contribution 12.96 million. Deduct the fixed overhead 7.56 million here. You end up with the expected monthly profit of 5.4 million. Same numbers, you'll have to rotate here and there and give that answer. Remember the relationships, my dear students. You know these, right? From small days, you are learning revenue minus total variable cost will give you the total contribution This is just to remember. Total contribution minus total fixed cost. Fixed overheads will give you profit, total profit. At break even, profit equals 0 and total contribution equals total fixed overheads. Please remember this. It's not a part of the answer, but I want you to remember this concept for single unit, single product, also multiple product, also same concept. Only difference is that you are getting the number of sales mixers instead of the number of units. With that standard sales mix ratio. That's the only difference. Nothing else. Okay. Right. Moving on to the part B. Part B, assess the revised break-even sales. Now, what has happened is advertising cost is 10%. Increase the advertising cost by 10%, which will change the monthly sales mix with no change to the product specific and general fixed overhead. No change to the other overheads, but the advertising cost goes up by 10%. And production or sales quantity, the mix ratio is 36,000, 12,000, and 30,000. Okay. Right. So here, early it was 12, 36, 24. Now it's 36, 12, 30, right? So the new sales mix ratio is like 6 is to 2 is to 5. It can be divided by 6,000. 6 is to 2 is to 5, right? 6 is to 2 is to 5. Contribution per unit, no change. No change in the selling price, no change in the variable cost. Same contribution per unit. So you just copy down here. 6 into 2 into 5. 6 to 5. One packet contains 6 units of X, 2 units of Y, 5 units of Z. Now the sales mix ratio has changed. So 6 into 220,000, 320. 2 into 160, 320. 5 into 190, 950. You end up with addition 2,590 contribution per mix, not mixers, 2,590 contribution per mix. Okay, contribution per mix, right? Contribution per mix, not mixers, it's contribution per mix. So part 1, they are assess the revised break-even sales in units and value. Sorry, this has to be Roman number 1. This has to be Roman number 1, not Roman number 2. Right? So this is an additional calculation, just like what we did here. Just like what we did here. It's an additional calculation for you to get the contribution per mix. And if you just get the total new contribution, just multiply by this, then you get the total new contribution. 336,000. So here, like these two are multiplied, you end up with this. These two are multiplied, you end up with this. These two are multiplied, you end up with this. The total new contribution with the revised sales mix, 15.54 million. Specific fixed overhead, product specific fixed overhead, no change. General fixed overhead, no change. Total production and fixed overhead, no change. Production overheads, you just multiply that by the number of units, 70 per X unit into 36,000, right? This is like 36,000 multiplied by 70, you get. 36,000 multiplied by 70, okay? 12,000 multiplied by 50. 12,000 multiplied by 50, okay? 30,000 multiplied by 65. But you earlier we did that, my dear students, for all the three fixed overheads. Now you can't do that because advertising cost is changing. They're talking about advertising cost, increase the advertising cost by 10%. So what I have done is increased by 10% and not production content depending. Earlier advertising cost was like you need to calculate that. You need to calculate it. Let me help you there. Earlier advertising cost was, I will calculate it here. You get advertising, no? Advertising cost earlier. 60 here. This 60 has to be multiplied by 12,000. 60 into 12,000. Okay. 60 into 12,000. Plus 40 here. I'll just use a different color. 60 into 12,000, 40 into 36,000. 40 into 36,000. Now it's not depending on the number of things they say, it's 10% increment of that. 50 into 24,000. 50 into 24,000. Is 50 into 24,000. Okay. So 60 into 12,000, you can use your calculators. 40 into 36,000 plus 50 into 24,000. 3,360,000. Okay. That's how I got it here. 3,360,000 multiplied by 110%. By 10%, it goes up. 3.696. Increase by 10% and not production content depending. So now revised fixed cost is 5,070,000 here plus 3.6 million here, 8,766 million there, 8.766 million there. Okay. So you got the contribution per mix. You have the total fixed cost here. Leave this total new contribution separately. 8,766,000, this amount divided by the contribution per mix. Break-even sales mix equals total fixed overheads divided by contribution per mix. Okay. 8,766,000 divided by 2,500. You don't get a round answer. 3384.55. We round it up to 3385 mixes. You round it up to the upper value, right? If you sell 3385 mixes, you are breaking even. You are moving on to the profits. Now, sales mix ratio, new sales mix ratio was 6:2:5. So break-even quantity you get, first part is break-even quantity. 6 into 2 into 5, you multiply it by 3,385. 6 into 3,385, 2 into 3,385, 6,770, 5 into 3,385. So you get break-even sales quantities. Those figures multiplied by the selling prices, no change in the selling prices, right? Goes way up to the top and you get the break-even revenue. Always challenge is to get the break-even quantity. Once you get the break-even quantity, just multiply by the relevant selling price of that product. You end up with the break-even revenue, right? Don't worry about the value here. You can multiply, use your calculator and get that. I'm not too much worried about the calculation. I'm explaining the method. Part 2, they are asking, using necessary computation, validate whether finance manager's action for this proposal was correct. Now, finance manager came up with the proposal and given his consent for this proposal. Whether it was correct, we'll have to say. Okay. Now, revised monthly sales mix is this 36,000, 12,000, 30,000, what we got here. And you get the contribution per unit. You got the contribution per unit here. And you have the new contribution that we have already calculated. You did already there. This part is actually not needed here, but I have done it. So you can just copy paste it. Production related fixed overheads, 5,070,000. What we got here. Advertising fixed overhead. Revised expected monthly profit is 6,774,000. Earlier under part it was 5.4 million. Now our revised expected monthly profit has gone up 6.774 million. That means that's an increase of 1,374,000. Since there is an increase in profit by 1,374,000, the finance manager's action to give the consent to the proposal is justifiable. Okay, you need to compare the part B expected monthly profit with part A expected monthly profit. If part B is higher, finance manager's action is justifiable. Otherwise, you can't justify. That's what you need to say. Final part is on discontinuation decision. Since the quantity of product Y has been reduced in the revised sales mix, the management of XYZ Limited is considering discontinuing the production of this product. Advise the management based on the financial and other aspects of the day. That's somewhat involving theory also, but financial aspect also. I have shared something. If you discontinue product by, right, it's the revised sales count is 12,000. Now, since it has come down compared to earlier, they are thinking of discontinuing. Contribution, we are earning 1.92 million. Product specific overhead cost is only 30. General fixed overhead will be anyway there. If you discontinue product price, general fixed overhead will anyway be applicable for what you call other two products. You'll have to share. But product specific overheads will be a saving. So 13 to 12,000, you are saving only 306,000. Profit from product wise, 1.56 million. So still, even though the volume is lower, my dear students, still it earns a profit, right? Product specific overheads, when you deduct, still it has a positive impact on the P&L of this company, right? If the product wise discontinued, the excess resources this should be either utilized to produce X or Z. Else a new product must be produced that generates a profit higher than 1.56 million. Either you need to use those resources to produce X and Z, or come up with a new product that generates a profit more than 1.56 million. Otherwise, it's recommended continuing with Y. Other concerns, sale of product XYZ should not be reduced. Now, maybe because of Y, people are coming to buy certain products of X and Z from our company, because they can buy everything together. And maybe Y is required for usage of X or Y, is it? We don't know. So if because of not continuing with Y, if people stop buying X or Z, or if the quantity of sales come down, that's bad. It should not be. Those are other non-financial. It's also financial, but other concerns. Impact of excess labor handling as a result of discontinued product Y should also be taken into account. There were some laborers used to produce Y, now they have to be utilized for X or Z, or you start with a new product. That also has to be looked at. Decision may affect badly on the goodwill of XYZ Limited. Why did they discontinue this product? It's loss making, or is it not generating attractive profits? So it's bad on your product portfolio. If it is giving a positive impact, still you can continue. So these are some of the aspects that you can look at. 4 marks. Advise the management. So my advice will be, therefore, it is recommended to continue with product Y unless a better attractive option can replace the product, providing a solution for all above concerns. Okay, that part also I will add. And with that, I will, share this one again. Okay. I will share this with y'all again. Give me a second. I had to save at another place and then only I can share it. Give me a second for that. So that you have the answers. So that you have the answers. But I believe there'll be a other communication from Institute of Chartered Accountants as well. Somebody has asked, I'm sorry, I'm just yes. Okay. I'm done with the paper. Let me share this. Hope you all can download this. If not, definitely Chartered Institute will also communicate this to you all. Okay. And before I stop sharing my screen, just a summary of the paper. These are the 5 areas in your syllabus: cost management, planning and control, decision making, risk and uncertainty, working capital. MCQs carried 6 to 10 is to 4 is to ratio in terms of marks for these 3 areas. Question number 2 is on transfer pricing coming under planning, part B. Question number 3 is on pricing, mainly coming under decision making. Question number 4 is on working capital management, 10 marks. Question number 5 is on 5 was actually higher. This learning curve effect and the what do you call life cycle costing, that again covers into part A. Okay, part A, 10 marks. And question number 6, the decision tree carried 17 marks and the evaluation. A small section on NPV and discounting factors and annuity factors, 3 marks coming for long-term decision making. So that's how 20 marks were composed of. Question number 7, 16 marks were on basically break-even content, the CVP analysis. 4 marks were on discontinuation decision. So 20 marks altogether. So this is the ratio, like 20, 20. The B part I have reduced a little bit because I have given some excess marks for C and D this time. Slight variation can come, students, because it won't be exactly equal to the weightage, but it will be almost equal to the weightage. So this is what we have. So from my end, thank you so much for being here for more than 5 hours. Yes, it's almost 5 hours from the point we started. Yes, I took a little bit more time to explain some additional things as well. If you have to clarify anything further, please ask now, or else we can wind up the session for today. And I wish all of you all the best for the upcoming exam, not just CL3, whatever the subjects that you are doing. Please keep this momentum, keep this commitment till the exam is over, until you make sure that you pass this hurdle, right? So do more and more questions, do the past papers, do the questions related to other exams that contain management accounting. Look at England and Wales Chartered Institute, the books and the questions. Practice the questions as much as possible, covering the syllabus relevant for our syllabus. So doing questions, and if you don't remember the answer, if you don't know how to answer, go back and check the theory. Go back and check your notes. That should be the approach. Any questions if you have, I'm okay to answer. Don't worry, I'm still up. 12:44 a.m., 12:45 a.m. Right? I won't get angry if you ask any questions. You can ask. If not, we can conclude the session. I think there are no questions. Everyone is eager to leave. Thank you so much then, and wishing all of you all the very best, and looking forward to see all of you pass the exam, the corporate level, and quickly finish the strategic level and become chartered accountants. Thank you so much for being here, my dear students, and thank you so much for taking effort to sit for the mock exam and taking effort to understand how you answer the mock exam. Thank you so much.